There's way too many people in the market right now gambling money. They have no clue how to look at an income statement, a balance sheet, a cash flow. They have no clue how to value companies, how to run projections. When you put $13,000 into a stock and you take out $279,000, hard to complain about that. I used to make $50,000 a year and I thought that was a lot of money. Keep it simple, stupid. People way overcomplicate this game. They try to chase short-term gains and then they wonder why they do so bad over the long term. No one wants a piece of Google 6-9 months ago. No one, except me. You either had a situation where you had life-changing money in one stock or you underperformed the stock market by a massive amount. If you're in the top 1% of retail investors, you're going to likely end up making more money than you ever dreamt. I wouldn't be surprised if in 10 years, I'm making 7 figures plus a year. Today, it's about $3.7 million. What an incredible move over the past year. Bitcoin is one of the biggest risk-on assets out there. If you were in Palantir over the last 3 years, let's be very crystal clear. You got to be flipping my flapjacks. We got so much to get into in today's video. I hope you guys are ready for a beast one. Sit back, relax. We got a lot to go through, a lot of important things to discuss in this one here today. Public count closing at $3.74 million, up $36,000 here today. Congratulations, everybody out there making a few dollars for your name, right? Had a lot of big movers here today. Salesforce up 3.6%. Meta, very nice move. Meta was up $35,000 in the public count here today. Estee Lauder is so sneaky. Look at this stock. Up another 1.75% here today. Now we're up almost 50% on Salesforce stock, up $61,000. That one's just a sneaky gainer there, EL. Shopify is another sneaky gainer for me. I have this as a position in the Patreon portfolio, not the public count, the Patreon portfolio. Now up 145% on this stock. It's all the way up to $162. It just continues to roll higher and higher and higher. And, you know, it's not the most talked about stock, but man, there's some stocks out there that are just absolute beauties, and the Shopify is one of those. Two things I want to get into before we get into the reactions in this video, okay? One is I'm going to show you all the sells I've had in the public count this year. Every single one of them, we'll talk about it, okay? Second thing I want to get into is the next thing I want to sell, the next stock I want to sell, okay? So we'll get into all that at the very beginning of this video. From there, what I want to get into is some reactions. Oh, well, I also have to talk about something very, very bullish if you're an Estee Lauder or ELF shareholder out there, okay? So we'll speak about that. Then I want to react to this video here from Mike Wilson 24 minutes ago. Recent market weakness will lead to medium-term strength. That should be an interesting one to react to. Market is on its way to a Santa Claus rally, says Bank of America. That should be interesting. This one's crazy. For too many young people, investing is like gambling. It's a warning sign. Huh. Okay, so looking forward to reacting to that one. That should be interesting. Like, should young people not be investing? Like, what is going on here, okay? Stocks have a pretty good backdrop for 2026, says Piper Sandler. Looking forward to reacting to that one, share my opinions and perspectives. Bryn Talkington sold out of Palantir, out of Salesforce yesterday. What? I'm looking forward to reacting to that one because Salesforce, I've been buying very, very heavily here recently. So I always like to hear when a Wall Streeter selling one of my stocks. And if you watch yesterday's video on the main channel, you know, that should be very, very interesting. Okay. I appreciate y'all for joining me as always. Thanks so much for being here. One thing only I need from you guys. If you could just hit that little thumbs up icon. If you haven't done so already, please do so. And to everybody that's already done it, thank you. Thank you so much for going ahead and doing that. If you want to be subscribed here, you can certainly subscribe. We are now at, how much? Dude, I don't even know. I don't even know how many subscribers we have on this channel now. I don't even want to say a number because it might be completely wrong. It's a good amount though, and I appreciate each and every one of you that are subscribed here to the channel. Additionally, pinned comment down there today if you're looking to apply to join private stock group, private wealth group, all that good stuff. That's access to all my course curriculums, private Discord chat, see the moves I'm making in my multi-million-dollar portfolios, all that good stuff. We are now up to 3,142 members. I am shutting the group down to new members at 3,300, ladies and gentlemen. So that's only 158 spots left open for the private group this year, and that's not very many. And at some point in 2026, I'll open it back up, but I need to give my guys a break. It has been ridiculously busy for them this year. And you got to understand, like, I don't think people understand, like, you know, the people that are on my team that work for me, these people are all stock market investors, and many of them have multi-million-dollar portfolios. Like, I'm sure a lot of you guys have spoken to Andre before. Andre's got a portfolio of several $1 million. You know what I mean? Like, these guys, they need time for themselves and to look into stocks and, you know, how to run their portfolios and all that good stuff. Like, you know, so it's just been flat out super, super busy, and I'm super happy. You know, people are taking investing more serious and join the private group and want to get access to 1000X and all that good stuff. Like, you know, level up, baby. But it's been overwhelming. So we're going to shut it down here. 158 left open spots, and that's not very many. That's gonna fill up like that, and then we'll be shut down, and we'll open back up at some point in time in 2026. But I need my guys to catch their breath because it's been too dang much. Okay, alrighty. So let's get into this. Here is every single stock I have sold this year in the public account. Okay, so right off the bat, I had some Duolingo put options. Let me be the first to say I made incredible gains on that in a very quick amount of time. 37.9 I put into it, and I ended up taking out 57. Right, so $19,000 gain, and I think that was in a matter of like weeks. Let me be the first to say I made a huge mistake not holding those longer. I could have made a $40,000 or $50,000 profit on that if I just held a few months longer. Just a few months longer, I would have walked away with a $50,000 profit on those put options. They didn't expire until March of 2026. But here's the thing. When we're talking about hedges, which if I buy put options on a stock, it's because I'm hedging my portfolio, right? Because I think there might be downside in the market, or I just want a little insurance. No different than you have health insurance, auto insurance, homeowners insurance. Hopefully you never have to use it, but if you do, it's there for you, right? And so Duolingo is kind of a hedge about if this market goes south, Duolingo is probably going to go south. Stock's probably going to go south anyways. So if the market gets hit a little bit, like that's double whammy. But I just took the profit, man. I took the profit too soon. $19,000 is $19,000. Like, it's nothing to sneeze at. Like, I think back to the days I worked at Quick Trip, and I used to make $50,000 a year, and I thought that was a lot of money, right? And, made that in a few weeks on those put options. Just a very small hedge there went a long way, but I could have made 50,000 plus. So it is what it is. Costco, I made $9,500 on some Costco put options. That was early in the year. Toll Brothers, I had put options there. I made $7,800. Walmart, I had put options, made $7,300. And the best part is, I made a lot of money with put options this year in the public account, and it wasn't even a bad year for the stock market. That's the most ideal thing. And additionally, all these positions I actually sold too soon. If I would have held them just a few days, few weeks, or a few months longer, I would have made more money. But the moral of the story is, when the market's going up and you can still make money from your puts, for your hedges, from your insurance, it's like getting it both ways. Like, that's perfect. That's ideal, right? Monster, I had a small position on Monster. I sold out of that early in the year, took a $5,600 gain there. Celsius, took a small gain there, $4,500 into some shares. At the end of the day, I shouldn't have sold those. That was just a mistake. Celsius is still a significant position in the public account, but that was just a mistake. Whirlpool, I had a very small position there. Then I moved out. Thank goodness I did that. It took $339 in profits. That was just one of those that, it just was what it was. Adobe, I think I put that money into Salesforce. I felt like I was a little overexposed to Adobe, and I think I put it in Salesforce, if I recall. So it was just $213 profit there. So that was just kind of like things like Whirlpool, Adobe, just very small moves. Even the Celsius move there, even the Monster move, right? For a portfolio that's nearly $4 million, these aren't like big moves. It's just like small little stuff, right? Palantir, this was a big move. So Palantir put $17,700 in those shares, ended up exiting with $307,000. So can't complain about that. Took long-term gains on Palantir of $289,000. Keep in mind, if you see me take short-term gains in a stock, it's usually going to be little money. If you see me take long-term gains in a stock, it's usually going to be big money, right? Because some of these smaller ones can be like hedges, like these were, or it could be situations where maybe I was in a stock and I never built it out into a big position. So I'm like, this is in no man's land. I need to sell out of it, things like that, right? Now, in regards to Palantir, listen, I would have been better off keeping all those shares. You know what I mean? Like, I've made so much money. How can I complain? I'm not complaining. I'm just saying, like, I would have been better off keeping all my shares. The bottom line is, when it comes with the stock, if I feel like there's a low probability of making money in that stock over the next 3 to 5 years, I have to move out of it, right? And so with Palantir, I sold almost all my shares in all my portfolios. I have very small positions left in Palantir. I have a position in the Patreon portfolio. I have 1,000 shares in the public account. I have hardly any Palantir. Now, keep in mind, 1,000 shares is still, $177,000 or whatever, but it's very insignificant. And that's because I believe Palantir does not have much upside ahead for the next 3 to 5 years, essentially. I could be wrong about that. I would I'd be happy if I'm wrong about that, just to be quite frank. You know, at the end of the day, I have 1,000 shares, and plus I have it in the Patreon portfolio. I don't think I have any shares in my private portfolios of Palantir. So, but moral of the story is, it's just the valuations just ran so heavy. The forward P, the 2-year forward P, it's going to be very, very difficult to make money in that stock, in my personal opinion. Unless if they keep growing at 60% revenue, year in, year out for the next 3 to 5 years, whoa, there's going to be a lot of money to be made still in Palantir. You'll see that company go $1 trillion plus market cap. But I do not believe the 60% type revenue growth they've been putting up recently. I don't believe that's sustainable. I believe that's a short-term phenomenon, and then they're going to probably even out at more in that 25 to 35% revenue growth range, which is phenomenal, but that basically will make it very difficult for the stock to be a money maker 2026 through, we can call it 2030, okay? Revolve took a $3,000 long-term gain there. That's still a decent-sized position in the public count. PayPal did a little positioning there, $982 gains. PayPal still a significant position in the public count. Meta took some profits there, $53,000 profit. That was $17,000 of cost basis there, and took $70,000 out. So $53,000 in long-term gains. That was just, a little overexposed to Meta. I want to diversify a little bit, so I sold a very small amount of shares there. Meta's still a I don't know. I think Meta's either $1 or $1.2 million position, something like that in the public count. Tesla, I obviously sold completely out of Tesla, right? You can say I definitely could have been better off if I held those shares for sure, right? $266,000 long-term gains. The good thing is with some of these stocks is it's always nice to be able to look back and say, darn, I should have held for longer, right? I could have made even more money. But at the end of the day, when you put $13,000 into a stock and you take out $279,000, like, it's hard to complain about that, right? I could have been a little better off, but it is what it is, right? This is basically nothing here. PLTZ took a $1,500 loss there, and then I sold out of that one. The hard thing with that one is Palantir is just so strong fundamentally as a company that although the valuation is insane, and although I don't think there's much upside potential for Palantir for the next several years, right, it's a hard stock to bet against when the fundamentals are as strong as that company is, right? And then Planet took an $80K long-term loss there, and then about $4,700 short-term loss in regards to Planet. Tough thing with the Planet is, I really like that company. I like the management team over there. The industry is obviously a massive industry. It's just the government keeps screwing this industry. They make it insufferable for these companies to ever make a profit and succeed, and it's just brutal, man. And so you're just stuck with these companies that are like, they have so much potential, but the government's just not allowing it. If the government ever gets out of that industry's way, like, these companies have years and decades to run. So I'm keeping an eye on the industry. I still have some shares in some other portfolios. I'm keeping an eye on the industry. If I feel like the government's finally going to for real get out of the way and it's not just rumors, because we've heard so many times, oh, this administration's going to do this, and oh, the politicians are going to, and they never do anything. If I actually see some action, then we're talking. Then we're back in business. I can position into these, because then those stocks could actually be ready for multi-year runs. It's not like, even if I miss the first initial pop on those stocks, who cares? Those stocks would then be positioned for 5, 10, 15, 20 years of gains. But the government has to get out of their way, man. And the government just continues to be there. Now, next up here that I'm thinking about selling in the public count is my TSLZ. This is my Tesla hedge here. So this is one that hasn't gone well so far, down about $5,100 on this one. My thought is I'm planning on keeping this into the first quarter. My guess is probably till February or March. We'll see. But this is one I don't want to be in long term, right? Tesla's a really tough one. And as any short seller will ever tell you, Tesla's a tough company to bet against. Very, very tough. And the reason being is it's just like the company's trading at like a $1.5 trillion market cap. It makes no sense. The forward P is like at 300 something. The 2-year forward P is 222, and we'll see if they can even increase profitability that much over the next several years. A price to sales ratio is astronomically high. It's all ridiculous. But just because it's ridiculous doesn't mean it needs to go down. In the short term, at least, like, could take a year for it to go down. It's ridiculous. It's out of control, but it is what it is. And so, man, tough. We'll see what happens. I've also thought about doubling down, in regards to that matter, and taking that to an $80,000 position or something. So I don't know. We'll see. the bottom line is with that insurance, it's tough, man. It's tough, especially some of these dang companies, okay? Alrighty, next up here, we've got some bullish news after hours here that just came out in the last hour or two, and that is Ulta. Ulta earnings came out. From what it looked like, they beat revenue estimates by around $150 million. Some people had them at $180 million beat. So let's just call it $150 million to $180 million of revenue beat, right? So revenue is stronger than expected. What does that mean? Okay, first off, I don't care what Ulta's profitability is, right? Because I'm not an Ulta shareholder, so it's irrelevant to me. What I do care about is how their revenue is trending, because if their revenue is much stronger than expected, then that means what? They're moving more product than what they expect. And if they're moving more product than what they expect, then what does that mean? Well, that could be bullish for companies like Estee Lauder, could be bullish for companies like e.l.f., right? e.l.f. has very nice positioning in the Ulta stores. And so Estee Lauder has some brands, some products in some of their stores. It just depends. It's kind of a hit or miss in regards to that. But overall, that's, I would say, a bullish trend. If Ulta came in and missed revenue, I wouldn't feel too good about that. Additionally, this doesn't even have November in it, right? This is, as of October 31st. And from what we've seen, spend looks very, very strong out there in November for a holiday season. So, bullish for Estee Lauder, bullish for e.l.f. Those two companies, I don't stress about them at all. E.l. is a sneaky gainer. The turnaround's already started in regards to Estee Lauder, and they seem like they're just starting to hit their stride again. And as Wall Street gets more confident in Estee Lauder, they're all going to come flooding back to that stock. Because remember, there's something I want to make sure everybody knows before we start reacting to videos, okay? It's a little gem dropper here. Wall Street loves certain stocks for certain reasons, okay? It could be because of their margin profile, could be because of trust in the business model overall, could be various different reasons, right? Nike has always been an example of a company that Wall Street loves, right? They haven't loved it the last few years because the numbers went really south because of the previous management team. We don't need to go into all that, right? But the bottom line is, like, if you look at Nike's history over time, Wall Street loves it. As soon as the numbers get right again, they're all going to come flooding back to that stock. What is another perfect example of a stock that Wall Street has always loved? They haven't loved the last few years, but man, they've always loved this stock historically. They're already starting to flood back to that stock. It is E.L., Estee Lauder. They've always loved Estee Lauder. The margin profile of that company, consistent revenue growth, multitude of brands. There's not just like one brand goes under and then they're screwed. There's a multitude of brands there, right? There's many different growth levers for the company to pull from. They love that stock. And so they're already starting to flood back to it because the numbers are starting to reflect positive again. And so as that happens, more and more momentum comes in, right? And what's impressive about Estee Lauder is how much strength it's showing here at the end of the year, considering we're in tax loss harvest season. So, and that's a stock that I would imagine, not many people have made money on other than myself or a few people that have bought in this year. And so the fact that stock is so strong even during tax loss harvest season definitely shows that I believe there's been an inflection in the numbers in regards to Estee Lauder, and it's just sneaky. It just keeps sneaking up. It'll be up 1%, 2%, 3% in a day. No one really looks at it, and it's just sneaky gains. And keep in mind, when you get a 1.7% gain on another 1.7% gain on another 1.7%, the number starts to become a lot bigger over time, right? Because everything starts to compound. So this is something I kind of keep in mind there. So bullish. Okay, let's react to a bunch of videos here. Oh boy, this is a banger. We got a lot to go through here.
Continuation of this year's story. I mean, we had a view coming into the year that they were going to probably do the growth negative policy stuff first, and it turned into sort of kitchen sinking it. And that all happened faster and more dramatically than even we predicted. So that when they flipped the switch in April, I mean, now we're looking at this just reversion of all of these revisions that got so negative. And now, I mean, to be honest, some of the stuff they've done has been even more constructive. I mean, the big, beautiful bill turned out to be much bigger than we thought, particularly from a CapEx incentive standpoint. There's a real benefit to the consumer in the first half of next year in terms of tax cuts and tax benefits from the SALT deductions increasing, as well as the tax on tips, et cetera. Then you have the story with the Fed now kind of turbocharging this story. So you've already had the earnings revisions. The Fed's now is going to be tailwind at your back. And this is the broadening out story that I've kind of referred to several times in the show already. So this is where I think investors have to make a choice. There's a fork in the road now, as Yogi Berra would say, take it. Okay, we're going to take the fork towards the broadening out. And that would be areas like consumer discretionary, some of the financials that haven't performed. Some of the financials have done really well, but there's parts of the financial sector that haven't done well. Transports, you mentioned that. That's an area that's really suffered. Some of the commodity patch hasn't done particularly well. Consumer goods over services. So there are plenty of things in the market that have not worked yet, that don't have high multiples, where the earnings are going to surprise on the upside. You get multiple expansion and earnings growth.
So you see the benefits of the tax bill. Any of that offset by increased premiums for healthcare with the roll-off of these subsidies? Because, that's a big number. But then you might say, hey, listen, that's a lower earning, consumer. So maybe it's not that big of an impact on the broader economy.
That's right. And the immigration restriction, because that clearly was a funnel for consumer spending, but once again, lower end spending. So it's a good trade-off. The biggest beneficiary of the bill is the middle income cohort, and they have a high propensity to spend in areas that we're talking about.
Okay, so I mean, there's so many various things that can happen here. What does the Fed do? Into 2026, I think that's going to be a big debate. Does the Fed keep lowering rates? If they are lowering rates, is it because they feel like the economy is going south? There's a lot of factors at play. The biggest, what the biggest thing that comes to my mind is in regards to trying to judge if the market's going to go up, over the next 3 months, 6 months, 9 months, 12 months. The biggest thing that comes to my head, Bitcoin. Bitcoin has shown stability here recently, and the stock market's shown stability. If Bitcoin starts going south again here in the next few weeks or, next year, the market could get shaky again. So, I'm actually watching Bitcoin price quite significantly and will be for the next several months, because it's going to tell you a lot about where the market in general is headed at. If we can see stability there and it just kind of slowly goes up, I think we're fine. But if you see Bitcoin start to weaken again, don't be surprised if this market takes a turn lower.
It's here. You got your 2020.
But what does all that mean long term? Nothing. So what do? You buy great companies at attractive prices. Keep it simple. This is entertainment. We can talk about where we think the market's going to go short term, medium term, blah, blah, blah. But at the end of the day, remember, don't make your actions based upon what you think might or might not happen in the stock market short term, because you don't know.
26 outlook finished up, ready to go. So
he doesn't know. Mike Wilson doesn't know. I can tell you that much. We just watched, Mike Wilson was so wrong. It wasn't even funny a couple years ago. So, in trying to make his market calls. So keep that in mind.
Plan of attack that you're talking to investors about.
Well, right now, the momentum, as you already stated, is that this is an elf rally right now, on the way to a Santa Claus type of rally. So we're just beginning this right now. We had a lot of...
So they're working on it. You got to finish it up.
Right. They're in the workshop right now, and then ultimately delivery happens later. So why is that the case? Obviously, tailwinds coming in the first quarter of next year. Really, between February and April, you might see some good tax refunds, fiscal bill relief on the consumer side. Consumers already resilient. Boomers are spending. They're the biggest growth area, masking over some weakness in some other areas. But then you get the actual corporate tax relief as well. Tax, probably not the right word, but just in terms of fiscal bill relief, you get a couple of tailwinds. CapEx still moving forward. But the critical point is when have we seen the Federal Reserve cut rates into a growing momentum economy? Been a long time.
Yeah.
We know why, but at the end of the day, the third mandate, which is price stability, arguably speaking, asset price stability, is alive and well, and that gives us a very good comfort level for 26 being a proud bull, Mike, versus a stampeding bull.
What does that translate into, a proud bull, in terms of, if it's not stampeding, so what? It's not going to go up 20%, or it's just going to hold its ground?
Not going to go up 20%. Okay. We've seen that 23, 24, we're on track for that in 25. A proud bull is more, let's track earnings growth. Let's not expect multiple expansion. Multiples, we all know it, they're vulnerable. They're vulnerable to a negative growth shock, which we don't believe is our base case. When we look at profit growth being 14% or so, that could prove to be low if all stars align. But there's not a lot of downside in that profit growth number.
It doesn't seem like it. There's a lot of confidence in margins holding up, and I guess just the momentum.
So this is where we get into a very interesting debate, because this gentleman just said what? He said the Fed is lowering into, basically like a strong economy or a strengthening economy, those sorts of things, right? Which is very interesting. It's a very interesting comment, because there's plenty of people out there that say this is not a strong economy, this is not a strengthening economy, this is a weak economy right now. So that's where you get into an interesting debate right now, where you got some individuals say this is a good economy. We're strong right now. And you got other people that say, no, this is not strong. This is a weak economy right now, right? So what do you believe, right? Like, what's your perspective on it? Is it strong? Is it not strong, right? And I think it really depends on the sector. It really depends on what area you're talking about. Is real estate strong right now? Absolutely not. Absolutely not. Real estate's been dead for years, right? Are auto sales strong right now? I wouldn't say so. Stock market. Are the financial markets strong right now? Absolutely. Very, very strong, right? So it depends where you're at in this economy. I can't describe this economy as strong. I also wouldn't call it super weak. I think we're kind of meh. That's the best way I could put it. A truly strong economy is one where you feel like everybody's doing well. You feel like the financial markets are strong. You feel like real estate's strong. You feel like people are out buying new cars and buying new flat screen TVs and, spending on their homes and all that stuff. Like, that's a real, feeling of strong economy. Like, ooh, we're doing well. Like, everything's just going well. I can't say that. I also can't say it's a disaster. I can't say this is, oh man, we're so awful out there. I can't say that, right? Inflation's come down immensely. Wages are good. As far as unemployment rate, it's still pretty dang low. So, I feel like we're kind of in a meh right now. We have the potential in 26 to take it either place. But with some of the positive tax changes that are going to happen, we have a potential of the consumer strengthening in 26, especially if we can keep housing inflation at bay, insurance at bay as far as price increases and things like that. If we can keep a lot of that at bay and energy prices stay low, because actually energy prices are really low right now as far as oil and natural gas and whatnot, if that can all stay at bay, I think we could have a much stronger consumer in 2026.
At least in the biggest companies because of the CapEx trade. How do you think it breaks down, though, in terms of how much faith investors are going to place in everybody winning on the AI trade and not? Because we've already seen the market try to sort things out. Nvidia's forward multiple is down from 35 to 25.
Right.
Microsoft's down from 33 to 28 in 4 months.
Right.
Because, the earnings are going up, but we're not sure what we want to pay for them.
Yeah, I think that's well stated, because you had significant speculation in a few pockets across the marketplace. 3 or 4 of those pockets have basically declined into this, but yet the market held up. So what's happening is there actually is a broadening out happening. With better growth, more people participate. So we expect better participation, but still tech just hanging in there.
Yeah.
Their multiples are now a little bit more attractive. But what people don't really look at too much anymore is Mag 7, 5 of them have underperformed the S&P. The terrific 2 are the ones that have outperformed. So really the rest of the market is starting to feed into this narrative of better economic health, but it doesn't mean we're off to the races.
Yeah, I feel like people want to point to that. Only 2 Mag 7 stocks have outperformed. But the upside to those has been huge, and most of them are also up. It's not as if they've gotten left behind fully, but it shows you also how hard it's been to beat this index.
It's been interesting. It's such a time of the narrative shifts in regards to the Mag 7, the big tech. Like, the narrative is all over the place. Like, Meta, the narrative was so positive, 4, 6, 9 months ago. So positive. And then the narrative went so negative about, they might be overspending, blah, 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 right? Even though their latest revenue growth was incredible. It was like 26%. Like, are you kidding me? Like, that's unbelievable. Like, for a company Meta's size to be growing revenues mid-20s, it's unreal, right? And then the narrative goes so negative. Then all of a sudden today, you hear the news about they might cut a bunch of spending in regards to the metaverse unit, and stock goes up, right? And so if then that news is confirmed, don't be surprised if Meta starts to see more momentum. And next thing you know, Meta's at 700 plus again, right? And then Meta's on the way to 800, and then we're going to see Meta at $1,000. And it's just like, it's crazy, man. Apple, the narrative was so negative around Apple 6 months ago, right? Like, they're not spending on AI, so they're going to get left behind. Nobody's excited about their products, blah, 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 right? Then all of a sudden there starts to be this question about maybe people are spending too much on AI. And then people are like, well, Apple's not spending on AI really, so, They're just using all that cash flow to do share buybacks and dividends and all this other fun stuff, right? And so then people are like, let's position Apple, and they launched some iPhones that are selling very well, and then people are like, let's go, baby, Apple's the way. And then Apple, I believe just yesterday, hit an all-time high. And it's like Google. Perfect example. No one wants a piece of Google 6-9 months ago. No one, except me. And maybe a few of you guys out there. We were buying, right? I remember I bought those shares, what was it, April 23rd? And I made, I don't know, $72,000 or whatever on that little batch of shares I bought. Incredible moneymaker. No one wanted that stock 6 to 9 months ago. No one. Then all of a sudden, Gemini takes the lead in regards to how they benchmark these, AI products, and then Google keeps putting up solid numbers quarter in, quarter out. And next thing you know, oh my gosh, everybody wants a piece of Google McDougal. It's hilarious, man. The narratives are just shifting. It's here's there. It's like, come on, man. Come on. But that's what's going on in Mag 7. Nvidia was like, everybody wanted Nvidia. Like, stock went 200 plus. Then all of a sudden, people are like, maybe the spend is going to be toppy in 26, which is what I told you guys they're going to start to worry about. And sure enough, they're already worrying about it, right? And then we're starting to talk about competition in NVIDIA, and the competition's coming, right? And it's true, the competition is coming, right? You got all these private label chip makers, you got AMD stepping up. AMD really enters the race in a major way in 26 in regards to their sales bump up. It's going to be insane, especially in the second half of the year when the 450 hits. So, but now I'm starting to, I'll put on the Wall Streeters on CNBC. I'll be, working and listening to them in the background. And all of a sudden I hear them talking about competition, this, competition, that for NVIDIA. And it's like, it's hilarious, man. Like the narrative around these stocks is all over the flip and flapjack in place. Next one up here. For too many young people, investing is like gambling. It's a warning sign.
Writing recently about his concerns that many young people are investing like they're gambling, which he says is a warning sign. For more on that and on the markets, let's bring in Ron.
100%. I thought I was going to disagree. I thought he was trying to say people investing young is bad. Like, listen, this man is 100% on. There's way too many people in the market right now gambling money. They have no clue how to look at an income statement, a balance sheet, a cash flow. They have no clue how to value companies, how to run projections. No, they don't. None of this stuff. They're like, if I put them on a spot and I'm like, all right, tell me why this stock's a great buy. Tell me about the PE ratios on the stock. Tell me about what revenue growth rate they should have. Where's their earnings per share going over the next few years? What's their share? Be lost. They're just throwing money around, just gambling. That's complete gambling. And the crazy part is they're gambling their whole net worth. It's wild to me. So that is an issue, and that comes back to bite people. You know when it does? When the market goes kangaroo, and when it hits hard, bear markets. And you don't get many of those, but you get about 2 bear markets every 10 years, roughly. Almost a guarantee you get one, but you're likely going to get 2 bear markets every 10 years. And when those bear markets hit, those people that were gambling get absolutely decimated. They're done for, man. They'll lose their, 70, 80, 90% of their portfolio by gambling money in the market. Don't gamble money, man. I teach you guys all this stuff on a higher level, man. We'll send you steel membership cards to your house. We'll send them. Pin comment down there. Get in there while you got a few spots left open, man. Get you a lifetime membership card. I teach you guys all this stuff, or you can just gamble money and, do that sort of behavior. Do whatever you want, but I'm just like, come on, man. Let's take things up to a higher level. I never feel like I'm gambling in the market because I'm making investment decisions. I'm running my numbers. I'm running my projections, right? Doing this stuff on a high level, and it shows in the results, does it not? Yes, it does.
Krzyzewski, Chairman and CEO of Stifel. Good to see you. It's been a while.
Like, what did we have earlier? What did we have here? Let's see here. What did we have? Public count this year, $581,000 of profits taken. $581,000. $532,000 of that's long-term gains. $48,000 of that is short-term gains. So $48,000 short-term, $532,000 long-term, $581,000 total. It pays very well to not gamble in the market and invest and know what you're doing. It pays very, very well.
Not that long, but
I could lie, I bet.
Longer than we like.
Cheers.
The opportunity, speak for yourself. No, the opportunity, I was looking for you out in Utah. All your minions are out there, and you weren't there. But okay. So the opportunities for gambling are everywhere. I'm not sure what you're talking about here. Prediction markets, DraftKings, Crypto?
Well, it's all of it, but
options. I just heard of perpetual futures.
Well, you know what? Zero-day options and perpetual futures were the beginning of this, and now you have prop bets and prediction markets. And my concern is that if you can pull an app out and in one sleeve buy stocks, which, by the way, if you buy a stock, everyone can win. You're investing in the U.S. economy. There don't have to be a loser. Or you pull it out and you bet whether the coin toss is going to be heads or tails. One is compounding. Investing is compounding, and gambling is consumption. And they are completely different things. And if we, as a society or us as an industry, we need to educate the difference. Because this has been a gray zone, regulatorily, taxes. These prediction and prop markets are getting a little out of control.
I share your concern with this, but we also sound like old fuddy-duddies who don't want these new ways of bringing new consumers in. Even the SEC chairman who we had on yesterday said it's all manageable. It's
their 401k is through gambling.
There, but okay.
I assure you that we're not fuddy-duddies, okay? Gambling is consumption. You bet one way, I bet the other. The house takes
a zero-sum game.
Not only zero-sum game, it's negative return.
It's negative, right.
Yeah. So I think, look, I don't want to be a fuddy-duddy about that, so to speak.
So what he's laying out here, okay, like I get the gist of it. And what he's saying, 100% accurate, by the way. Gambling is consumption. I don't look at gambling. I look at gambling as a bad thing and a good thing. Let me explain. The bad part is when people are just gambling money they should be investing, right? That's a problem. When people are treating their investments and their whole net worth like it's a big gambling game, we got a problem. We got a big problem, right? That's going to lead to very negative long-term returns and a whole host of issues. On the flip side, I don't think gambling, obviously as somebody who lives in Las Vegas and this is a city built on gambling, right? I think in a controlled manner, it's fine. No different than, if somebody wants to spend $10,000 on a bottle of wine, do what you want. Or if somebody wants to buy a Ferrari, and spend $250,000 on a Ferrari, you do you. It's your decision. Where you have an issue is when people take it overboard. And when they're treating their entire net worth like it's a big gambling game. And that's where we run into an issue. And that's where we run into a problem. If some guy wants to, some guy that has a business that he makes $10 million profit a year, and he's got a net worth of, $40 million. If he wants to come down to the Wynn for a weekend and spend $500,000 gambling, it's fine. It's his decision. He's got a business that makes $10 million profit a year. He's got a $40 million net worth. If he wants to go blow $500,000 at the Wynn and have the time of his life, you do you. Go ahead. I'm not gonna judge you bad. If that same man has a business that brings in $10 million a year and he blows all $10 million gambling, we got a problem then, right? He's got no net worth, nothing to show for it. We got a problem then. And so you got problem gamblers, and then you got people that have a little bit of fun, right? You know what I mean? You gotta take apart those two. But there is an issue with people actually just gambling the market, and that's where we run into big problems, right? Because that's gonna destroy your long-term returns. Oh my gosh.
Did I characterize that correctly?
That's right.
And by the way, kudos. What do we call II now?
Xtel.
Thank you.
Yes.
Number one strategist for that call all year long, that there's something bigger taking place here. So tell us what that is.
Sure. The market's been very focused, of course, where interest rates are going and what's been driving that. I would say in 22 and 23 was really more about inflation. And in recent years, we've started seeing the labor market soften. And I suggest that investors have a brief definition of history and have to look further back. And in periods specifically where inflation anxiety was very elevated, like today. And what we see taking place today and for the foreseeable future is softer employment, providing for lower rates, and in a market that's we're seeing inverse correlations with equities and interest rates. That's been a positive.
Yep.
And that is what's been missing to get the market to broaden, get the economy to broaden, lower rates to get manufacturing, transportation, and housing to get back to a better backdrop in 26 when we see that.
If I could put it as the eureka moment as I was reading your work, it occurred to me like this. I keep thinking about softening employment data and falling interest rates and rate cuts as the end of a cycle. Right, that's what was happening in 2008. The economy's softening, the Fed's behind the curve, they're trying to catch up, and that's a bearish sign. But then I read what you're talking about. You go back to inflationary episodes where that's the top concern for the market. And once you have employment softening and the Fed's cutting, then that means you're through the bear market. That actually is the beginning, possibly, of a rally and a broadening. Yeah. So you're pointing to that playbook as to people say, how can we?
The issue, though, is you never actually know when the bottom is. You never actually know that.
Possibly be in the early innings. Look at how strong the market's been. Yeah. Does that give you any concern, though? Like, we'd be building on a rally that's been so strong for the past few years.
Well, I think we have to compartmentalize the rally and where it's come from. We had a big bear market in 2022. PEs collapsed. Credit spreads widened. And it took basically 23, 24 into 2025 to recoup all of those losses. So we had AI earnings, which meant large caps and growth stocks did much better. But look at the Russell 2000. It's back to its highs. None of that is about earnings. It's all PE expansion. And it's because inflation's come way down. Prices are still high, but let's not conflate those definitions. Yes, the labor market softened, but the silver lining of that is that 2 years ago, interest rates peaked when unemployment started going up. We had mortgage rates of 8%, the 10-year over 5%. And now we're almost 200 basis points lower. And yes, it is a bit of a no pain, no gain situation.
And unfortunately, or fortunately.
So for the last, we can call it 3 years, right? From Q4 2022 to Q4 2025, what was the play? The play was big tech. The play was Mag 7. That's where you make the game-changing money, right? Oh my gosh. AI-related stocks, Palantir. That's been where the big money's made. Where has the big money not been made? Dividend stocks, energy stocks, Russell 2000 type stocks, small caps, real estate type stocks, anything like that? No. Okay. Where do I see the biggest opportunity for the next 3 years? I think the biggest opportunity for the next 3 years is in a lot of these stocks that have been laggers for years. I'm thinking PayPal. I'm thinking Nike, I'm thinking Estee Lauder, I'm thinking a lot of the small caps, the Honests of the world, the Fubos of the world, a lot of those small cap stocks that have been dead and forgotten, right? Just as these big tech stocks were dead and forgotten 3 years ago, right? Meta, Shopify, those stocks went down 70, 80%. I showed you Shopify is $162 today, right? Good size position for me in the Patreon portfolio. Guess what? It's like 10% of the portfolio thinking about it now, right? Of that particular portfolio. Guess what? Shopify was $25 in 2022. People were selling it for $25. That's how bad it got. It's 162 today, right? Meta went to 88. I could run you through all these stocks. Like Netflix has gone up, I think, 600 or 700% since the bottom of where its stock price bottomed in 2022. So those are dead and forgotten stocks. No one cared about them, right? We got a whole new group of dead and forgotten stocks now that are just sitting there, that I think those are going to be the biggest opportunity in the next 3 years. Big tech, there's money to be made in big tech. Mag 7 for the next 3 years. Absolutely, in my opinion. But that's not where the big money is going to be made, in my personal opinion. The big money, the game-changing money, will be in a lot of these other opportunities. That's my personal opinion. I could be wrong about that. We'll see how it all plays out. But that's my belief if we're trying to think about the last 3 years and the next 3 years, okay?
This is a weird thing about COVID. There was a massive hiring surge. Yeah. The fact that we're talking about the Great Resignation and people just phoning in their jobs, like, yeah, thank you that I've arrived. It's not like that anymore. We're unwinding that. Yeah. So Amazon cuts 14,000 jobs. Sounds scary, except that they doubled their workforce to 1.6 million during the pandemic. So the labor market reset seems to be the market is still perceiving this as there is some right sizing going on across corporate America still, absolutely, which shouldn't be confused with kind of where we are in the business cycle.
Yeah, not kind of margin pressure, pain-induced employment layoffs, which is also happening as well. That you've got AI-related layoffs, you've got normalization from COVID, and there is a cyclical component as well, certainly in smaller businesses. And I think that's going to persist into 2026. I want to be clear. I think the labor market remains very sluggish.
Right.
But that opens the door for rates to be to continue drift lower, the Fed to start, to continue cutting, and seeing a broader improvement in housing, manufacturing, transportation. People have gotten so bearish on these parts of the market.
And look at the ISM again yesterday.
And it's still weak, but it's been kind of hanging around. And all of our forward-looking indicators suggest that finally in 2026, we'll start to see that get back into expansion. Up until 3 months ago, we were not seeing those signals.
What are those signals, by the way? It's fascinating.
So it's changes in interest rates, changes in oil prices, changes in money supply growth, changes in the yield curve. And I'm not even including the fiscal policy kicker that we're going to get in 2026.
Because you can do the expensing immediately of depreciation or whatever it is that the people saying it should be half a point of GDP.
In the first half. All of that's gravy, but it's really as simple as 2 years ago, we saw interest rates peak after rising into 2023. And they stabilized. The 10-year kind of bounced around for about 2 years and is now near the low end of it. The Fed's been cutting for over a year. It's those changes in rates which help to normalize the economy. And people are getting too stuck, I believe, in the bearishness and kind of thinking that this will never change. And that's where things typically do start.
No, I appreciate.
All right, next one up here. Oh, this one should be interesting. Bryn selling out of Salesforce.
Throwing in the towel, so to speak, on Salesforce ahead of the earnings report after the closing bell today. You're not even going to wait to see what happens. Bryn, why are you getting out?
Yeah, well, so I mentioned this on Monday. I've been in this stock for a minute, probably a quarter and a half. And I feel like when the market goes up, it doesn't go up. When the market goes down, it goes down slightly. I feel they're going to have very solid numbers, good free cash flow. We'll hear about some of their new customers. But ultimately, what makes a stock go higher? There's more buyers than sellers. And I feel that Salesforce right now, from a stock perspective, is stuck in the mud. And so I just don't think that we're going to hear tonight anything revelatory that's happening. I just feel like it's a moment in time and people are not wanting to, put more capital in this name. So I didn't want to sit through earnings in case the market has a negative feedback, which it's done on a bunch of stocks that actually had good numbers. So I wanted to sell before the earnings call tonight.
All right, listen, ladies and gentlemen, listen. What she just laid out there, that's a problem for a lot of investors. They get caught up in this mindset of like, oh, the stock isn't moving short term and I'm losing money or I'm not making money and blah, blah, blah. Don't overcomplicate this game. Listen, run your numbers, run your projections. Where do you believe the revenue is going over the coming years, the net income's going, the earnings per share? What's a fair PE that stock should be trading at? Does it show that you're going to likely get a great return from that stock over the next 3, 4, 5 years? If it does, own the stock, buy more of the stock. If you get dips on the opportunities, and then adjust your theses as time goes on. So adjust your base case, your bull case, your bear case. If the business is trending better than you anticipated, up your numbers over time. Things are trending worse, down your numbers over time. And then make your decisions based upon that. Don't try to make a fundamental case for it and then backtrack because, well, people aren't buying it, so blah, blah, blah. No. That's how you miss out on a lot of money-making opportunities. Somebody famously said, keep it simple, stupid. Keep it simple, stupid. People way overcomplicate this game. They try to chase short-term gains, and then they wonder why they do so bad over the long term. They look at their returns, they're like, man, how are my returns so bad versus... It's bad because they're so focused on the short term of these companies and what the stock prices are doing. And is the stock price seeing momentum or not? Like, come on, man. It's a problem, right? Make sure you guys check out my video I posted on the main channel, Financial Education. Posted this one last night. New stock I spent $30,000 on today. That covers a bunch of different subjects, but you guys will enjoy that overall. Alrighty, folks, if you're looking to apply to your own private stock group, private wealth group, access to 1000xstocks.com, all of that good stuff. See exclusive weekly videos, pinned comment down there. We're up to 3,143 members, so there's 157 spots open left, and those will fill up quickly. Look at some of those moves in the public count. Public count continues to roll on here over the last few weeks. Look at Elf on a Shelf up 8+% here today. It's a $6,000+ move. That one jumped back to 1,000% plus gainer for us. Honest was up over 5% today. Look at Palantir at a 3%+ move. You had Celsius up almost about 3%. That was about a $5,000 move there. Estee Lauder EL up over over 2%, American Express up over 2%, Revolve up about 2%. So definitely some nice moves out there. Google McDougal, congratulations to anybody that's a Google shareholder out there. Man, what a stock this has been. New high after new high. Closes today over $320 a share. Look at, we just had the flip happen, which is where you have made more money in a stock than what you put in, and that has now transpired for us in regards to Google. Back in April of this year, I put $69,000 in the stock, and now I'm sitting on a $72,000 plus gain. So that is always fun to see. AMD continues to bounce back strong. That stock 217 plus here today. Just last week, people were panic selling the stock for $195 for who knows what reason. I can't even remember. It might have been because of Google's chips. I can't even remember at this point in time. But they were panicking last week. Now they're buying it back left and right. 217. 250s coming up here next, right? This was a very interesting situation. I had CNBC on in the background while I was working today, and then all of a sudden I heard them talking about C3 AI earnings were coming out. I was like, oh my gosh, I forgot all about that company. 3 years ago, this company used to get put into the same sentence as Palantir. People thought Palantir and this company were the same, right? And look at the result difference between these two stocks over the past 3 years. If you were in Palantir over the last 3 years, let's be very crystal clear. You made life-changing money. Life-changing money. That stock is sitting on a 2,600% gain in the past 3 years, while C3 AI is sitting on a 27% gain the past 3 years. Keep in mind the S&P 500 is up about 76% over the past 3 years. So you either had a situation where you had life-changing money in one stock, or you underperformed the stock market by a massive amount. And think about the difference in what your lifestyle could be, like where your portfolio could be, all those things. If you'd picked, and there was definitely some people that picked C3 AI 3 years ago, and like that was going to be the winner chicken dinner. And some of us, like myself, we picked Palantir and we made life-changing money on that stock, right? 3 core subjects I want to speak about here today in this one. First one up here, how do you avoid a situation like a C3 AI versus Palantir? Okay, because that's going to be actually the most important thing we'll talk about here today in this video. I'm just going to drop some gems for you guys, because you might get into a situation down the road where you picked the wrong stock and you had an option between two and you picked the wrong one. You don't want to get into that situation, okay? Because imagine you look back and you're like, I'm sitting on 27% gain on C3 AI. I could have made 2,600% on Palantir. Like, you don't want that to happen to you, okay? So we'll talk about how to avoid that. Second thing we'll get into is a newish stock that I spent $30,000 on here today. Why I put another $30,000 into the stock? It's kind of a somewhat recent buy for me in regards to me getting involved with this stock, okay? So third subject we'll speak about here today in this video is my favorite fatty paying dividend stocks. Okay, we'll speak about that in this video. It's an action-packed one. I hope you guys enjoy this one. I hope you appreciate it. The only thing I ask from you in return for this video is that sign in my garage says it. Smash that like button. Hit that little thumbs up icon for me. That means the world. If you want to be subscribed to the channel and you want to see more of my videos in the future, make sure you're subscribed. It is free to do so. And I think we're at, oh gosh, I don't know, 906,000 or 907,000 subscribers now on the channel. Appreciate each and every one of you for being here. Pin and comment down there today. That'll be if you're looking to apply to my private stock group, private wealth group, take your investing game up to a much higher level than where you're at today. That's access to all my course curriculums, the private Discord chat, access to 1000xstocks.com, see all the moves I'm making in my portfolios. It's been an action-packed year. We're now up to 3,138 members in the group. We are shutting down to new members at 3,300 members. Okay, and we'll open it back up at some point in time in 2026. My guys need a break. It has been ridiculous this year. And so we're about to close this thing. So we got 162 spots open, which is not a lot. I'll just tell you that. That will probably be, honestly, probably in the next week or two. We'll likely, finish that off. So 3,300, that's where I'm closing the group at for this year. And at some point in time, when we catch our breath, I'll open it back up to new members in 2026. Okay. And keep in mind, this is pretty cool. Some people have been sending me these like messages on Instagram, posting on X and whatnot, posting on their Instagram X. And it's like, I guess YouTube is sending out like what channels you watch the most. And like, one subscriber sent me, this is so cool. Top 0.7% of viewers. This person said they're in the top 2%. So that's cool. I don't know how YouTube's doing all that, but cool stuff. Okay. Alrighty guys. So let's talk about how to avoid a C3 AI versus Palantir situation here. Okay. So if you want to know what are the things that you could learn in this life that will make you the most money, okay, there's a few things, but one of those few things is financial analysis. The ability to understand businesses, the ability to understand financial statements, run valuations on companies, right? And analyze the situation and be able to tell, is a stock a good buy or not a good buy, right? I figured that out way back in 2009. I kind of got acquainted with the stock market in 08. And then 2009, I started figuring out, oh my gosh, like this could be the highest income skill I ever, have in my entire life. Like this could change my life if I really get this skill done. And I was passionate about it and I love doing it and still love it to this day. And, about to be 2026, right? And so Moon's already out here in Vegas. And look at that. Moon's out and it's 4 o'clock. Yeah, I'll be flipping my flapjacks, man. Days are too short this time of year. So I figured that out way back in 2009. Every single person watching this video, you better understand financial analysis if you want to make a lot of money in this life, because I can tell you, pays very well. Pays very, very well to understand that, okay? No. I was actually texting with a friend here today. He was talking about, basically like hedge funds and, not that impressed by them. They don't even have very good returns and things like that, right? And keep in mind, if you're watching this video, you probably don't have the opportunity to invest, start your own hedge fund, right? You are in a situation where you're investing your own money. I said that's because they spend all day golfing and steak lunches with their clients rather than looking into companies. The industry is a joke for the most part. I said, like everything in life, you have 1% that are amazing, legendary, right? In the hedge fund community. 10% are good, 50% are meh, 10% are trash, 29% are super trash. So now look at yourself as a retail investor, as an average Joe investor, okay? And you're going to understand that the differences here is monumental in regards to where your financial life is at, in the type of lifestyle you're able to provide or not provide, right? If you're in the top 1% of, retail investors, right, you're going to likely end up making more money than you ever dreamt, more money than you know what to do with. Like, you're like, I don't even know how to spend the money fast enough because I made so much money in this game, right? If you're in that top 1%. If you're in the top 10%, we can call it roughly, right? You can likely create generational wealth. If you're doing this for many decades and you're good at what you do, stock picking, investing, running portfolios, you can likely create generational wealth that can last several generations of your family, right? If you're in that 50% bracket there that are kind of meh, if you're doing this over many decades, you might still be able to at least retire comfortable, right? That does not mean you're ever going to be able to really achieve all those dreams you really wanted to and live in that dream house and drive that dream car and go on that dream vacation and, all those sorts of things. But you could likely have a comfortable retirement, right? Now, if you're in the 10% that are trash, you're going to have a struggle making it. You're going to have a struggle making it. Now, if you're in the 29% that are super trash, you're working at Walmart at 80 years old. There's just no other way around it, like greeting the customers coming in. By that time, robots are going to be greeting the customers, so they won't even need you. So it's going to be a tough sledding, right? And so you got to understand, you need to do everything in your power to get up here, because this is where you really want to be, right? And so sometimes people are lazy and they're comfortable being here, and it's like, do what you want, live your life the way you want to live your life. But gosh, it's going to be brutal, man. That is going to be brutal. A few things that are key to really understand. If you really want to avoid a C3 AI that destroys your wealth versus, a Palantir that just, absolutely accelerates your wealth in a massive way, right? One is you got to listen to conference calls. So important in regards to these companies. When you're listening to those conference calls, you're going to pick up on so many things that are happening in the business model that are going to be able to help you judge the business better. Because listen to this, okay? Guess what happened back in 2022? I was listening to a ton of Palantir conference calls, learning more about the business, watching as many Alex Karp interviews and other executive interviews as I possibly could, talking with other people in the Palantir community back then, right? And getting their thoughts and opinions and seeing if I'm missing anything here as far as bullish catalysts, bearish catalysts, or anything in between, right? Putting in the work, really trying to study up on this as much as possible. That helped me out to understand Palantir on a much higher level, to be able to invest in that company in a very comfortable way and get a $7, $8 cost basis, whatever I have, right? It's incredible. Boom, game changing. If you don't listen to those conference calls, it's going to make it a lot harder for you to really understand a business on a high level. And you're not going to really know, is Palantir the winner chicken dinner over the coming years, or is it C3 AI, right? Additionally, you got to do things like perform SWOT analysis, strengths, weaknesses, opportunities, and threats of a business. Very important. You always perform SWOT analysis on any company you're thinking about investing into. If you had done this with Palantir 3 years ago, you would have walked away feeling pretty good about yourself. If you did it on C3AI, I'm not so convinced. And then strong moat versus a weak moat around a business, very, very key as well. You do those things, that's going to help you and boost you up to a much higher level if you know what you're looking for in regards to that. Okay. Another thing that gave me a lot of confidence in Palantir versus a company like C3AI, even though people were grouping them together 3 years ago, right, is in the private stock group, we have the Discord chat, right? It's one of the most valuable parts of being in the private group outside of the course curriculums. And we have a Palantir chat, okay? And we have a lot of individuals in the private group that, are software developers and other key positions at different big tech companies and things like that, right? And what I came across time and time again when we would talk about Palantir, that a lot of people that were really in the industry would tell me is Palantir had a one-of-one employee force, and it was incredibly hard to get a job at Palantir. Like, you could get a job at Google or Meta or Apple or somewhere like that before you could get a job at Palantir. It was incredibly hard. Like, their employee force was incredible at that company, right? So if you really have that special of individuals working at a company, right? Like, we're talking even maybe a tier up from the big tech companies. Good probability, whatever this company is going to build out for software is going to be magical, right? It's going to be game changing in regards to that. So that was another thing that gave me a lot of confidence, like really understanding, oh man. And I had this confirmed by several people about how special Palantir's workforce really was. And it was like, you got very extremely top tier talented people working at a company and they're all working together. They're going to create some pretty compelling products and services out there, right? Then what happened in early 2023 was a game changer. This took things to the next level. So what we had is what's called a fundamental change in a business model. A fundamental change can go one of two ways. It could be a fundamental change for the better, as this was, or it could be a fundamental change for the worse. Like some serious competitor came out for a company, they're going to damage that company, or something went super wrong with this company's product or service, and it's like a fundamental change is going to alter that business's growth rates for years to go in the future, right? For Palantir, there's something fundamental that happened that if you identified this, it was like, oh my gosh, like this is a game-changing thing. So one of the things, one of the big problems Palantir always had was their sales cycle was incredibly long sales cycle, like brutally long. Like it could take them 6 months, 12 months to land a customer. It was such a slow sales cycle. It was almost embarrassing, right? But that changed when they launched AIP. And what happened is the sales cycle for Palantir went from a situation where it took many months or maybe even a year to all of a sudden a sales cycle could happen in hours or days. And that was a fundamental change for the better for Palantir forever. And they covered all this at the time. And keep in mind, Palantir had already been bouncing by the time this launched and by the time they started talking about it. But gosh, Palantir back then was still like a $15, $20, $25, $30 stock. It wasn't a $200 stock or 170 something, wherever it's at today, right? So you still had like time to recognize like there's a fundamental shift going on here, right? And you could have moved your money out of C3AI and recognized like, okay, the real opportunities here, Palantir and what they're doing, right? Additionally, here's another thing you could have looked at. You could have looked at C3I's revenue growth, okay, over time. And what you witnessed was something troubling in C3I's revenue growth story, okay? It was so inconsistent. So inconsistent, it wasn't even funny. Like, look at this. They went from 17% revenue growth down to 16%. Then they went up to 20%. Then they flatlined. Not good. Then they went up to 28%, then they went down to 26%, then down to 25%, then negative like almost 20%, right? Not good. That's so much inconsistency. And especially for a company that is more in the software space, right? That should not happen. Like you want to see consistent revenue. You know what you want to see? I'll show you what you want to see. You want to see what Palantir's been able to do. Look at Palantir, 16% revenue growth, 19%, 21%, 27%, 30%, 36%, 39%, 48%, 62%, consistent growth, quarter in and quarter out. That's a trend you want to see. So you had many opportunities to move out of a stock like a C3AI when you could recognize, okay, this isn't adding up. Why is their revenue growth not consistent here? Why, you had plenty of time. You could have moved out of the stock in 23, could have moved out of it in 24, right? And positioned in the real deal Holyfield. So even if you didn't identify it in 22, like I did and some others that got in at $6, $7, $8, $9 a share, you could have at least moved out and still made honestly great money. You probably still could have got yourself 200% return, 400% return, 600% return, right? You wouldn't have got yourself 2,000 or 2,600% return, but you could have still made 400, 600, 800%, right? Which is, last time I checked, a lot better than 20%, right? So, some things to keep in mind here, right? Now, you got to avoid gambling the market like the plague. Okay, a lot of people gamble money in the market. So I'm sure there were people back in 22 that gambled some money into a company like C3AI. They didn't really know what they were doing. They didn't know how to judge income statements, balance sheets, how to run valuations. They didn't understand how to identify business models, run SWOT analysis. And they gambled, right? You got to avoid that crap like the plague. That's going to come back to bite you hard. When I went to buy Palantir stock years ago, that was an investment, right? It was an investment. I looked at the company, I looked at the company's balance sheet. It was extremely solid. They were starting to improve their profitability massively. I looked at the product roadmap and what they had going for their products, and I said, okay, this looks pretty darn compelling, especially at the given valuation it was at that particular time. So I made a wise investment. If you don't know how to identify business models, financial statements, valuations, you're gambling money. You're just throwing money around hoping it hits, right? And that's the same thing people do down at the casino. I live in Las Vegas. They do it all the time, okay? Avoid this, do this. There's a big difference between gambling, straight up gambling and throwing money around, and actually investing and being like, I've looked fully into this. This is a great opportunity, right? We're back in business. Just last week, 5 people in Private Stock Group hit $1 million plus in their portfolios. 14 people hit $100,000 plus in their portfolios. Incredible to see. These people who don't gamble in the market, they've learned under me. They've gone through the course curriculums. They brought their game up to a higher level. They're not there to screw off. They're actually there to play this game on a high level, right? And they get the results. And these types of people that will stick to investing, stick to great principles, they'll continue to thrive over future years. They'll make it through the bear markets, out to the other side, and they're just have fun in the next bull market and the next bull market after that and the next bull market after that, man. That's what you got to do. If you've never seen these awards, by the way, this is the one I send out to the 6-figure members. It's very heavy, like diamond award, crystal award. It's pretty cool. And then this is a 7-figure one. We actually changed up the styling a little bit in regards to the 7-figure award, but those are expensive awards and I ship them all over the world. And I never make anybody pay for them. I pay for them out of pocket. The awards, the shipping, a lot of times that's $100 or sometimes $200 between all that, and I pay for it out of pocket because at the end of the day, it's great to see people prospering and having success and things like that, and having something to recognize it, like a physical something, right? To recognize your success you're having out there in the market, okay? So there we go. Okay, next up here, newest stock I spent $30,000 on today, why I did it, and then we'll talk about some of my favorite fatty dividend paying stocks out there. Okay, so did you see the video I did 2 days ago on the channel? 7 stocks I'm buying now, December 2025 edition. What was the very first stock I talked about in that video? Do you remember it? It was a company named Salesforce. So I posted this inside the private stock group this morning, a little after 10 a.m. I said, I just did an abnormal big buy of $30,000 in a private portfolio. I bought CRM. They report earnings today. I wanted to build out my position more before earnings are released. I'm underinvested in the stock. My hope is the stock goes down as I want to buy more shares the next 3 to 6 months. If it doesn't go down and flies 10 to 20% after earnings, at least I built my position stronger. So it was a little over a $30,000 move. I let my private group know about it because it was an abnormally big buy. And so usually I just let the private group know about the Patreon buys and then the public account buys or sells, right? But since this was in a private portfolio and it was such a big number, $30,000 in a day, right? I thought I would let everybody know. And so, I went ahead and did it. Now, in regards to Salesforce, earnings are phenomenal. Stock's up nicely after hours. Now, in regards to this one, okay, where do I see the stock going? And we're going to get into all that here. As far as the top line numbers go, revenue was basically in line. Earnings per share came in at $3.25 adjusted versus $2.86. So top line, very nice there. Now, a few things here. If we look at current remaining performance obligations, came in at $29.4 million. That was up 11% year over year on a constant currency basis. So what we're going to see is accelerating growth in regards to Salesforce here. Remaining performance obligations came in at $59.5 billion. That's up 12% year over year. So that's a much stronger number than what their current growth rate is, which is actually what you want to see. If this was a lot lower number, let's say right now they were growing revenue 12% and their remaining performance obligations were only up 8% year over year, then we got a problem. We have the opposite going on. Third quarter subscription and support revenue came in $9.7 billion. That was up 10% year over year and 9% on a constant currency basis. Third quarter revenue was up 9% year over year and 8% on a constant currency basis. So look at that. 8% revenue growth on a constant currency basis for this latest quarter, but remaining performance obligations were up 12% year over year. It's good. It's really, really good. That's what we want to see. Third quarter operating cash flow, $2.3 billion. That was up 17% year over year, so way stronger, over a double up as far as percentage growth versus revenue. That's something you want to see as well. In free cash flow, $2.2 billion. That's up 22% year over year. Woo! That's a good number there. They returned $4.2 billion to shareholders, including $3.8 billion share repurchase, and they paid another $395 million in dividends. They raised their full-year revenue guidance to $41.4 billion to $41.5 billion. That's up 9 to 10%. So basically, they're expecting revenue growth to accelerate here. Good. I mean, it's just good across the board. We are raising fiscal 2026 revenue guidance to $41.45 to $41.55 billion. And Q3 remaining performance obligations was exceptional, up 11% year over year to $29.4 billion, signaling a powerful pipeline for future revenue, said Mark Benioff, the chairman and CEO of very, very much a business legend. Our agent force, this is a product I talk about a lot that's going to be very, very key over the coming years, kind of like I've talked about Palantir's products, back in 22, 23. This is going to be key for Salesforce in 26, 27, 28. And Data 360 products in the momentum drivers, hitting nearly $1.4 billion in annual recurring revenue, an explosive 114% year-over-year gain. We now have 9,500 paid agent force deals and 3.2 trillion tokens processed, underscoring the leadership in building our agentic enterprise and driving real outcomes. Our Q3 momentum and continued agent force adoption further reinforces our path to achieve our $60 billion plus organic revenue target and our profitable growth framework target of 50 for fiscal year 2030. Keep in mind they said organic. Why they say organic? You know why? Because a company might buy other companies over the next several years, which will boost up growth rates. So they're talking about they can do $60 billion plus in revenue a year by fiscal year 2030, just off what they have right now, not even counting future potential acquisitions, right? Now, Agent Force, Data 360, oh my goodness. Woo, they almost killed me. I had to drink something there. Agent Force and Data 360 annual recurring revenue reached $1.4 billion, up 114% year over year. Agent Force annual recurring revenue surpassed $500 million in Q3, up 330% year over year. Agent Force accounts in production increased 70% quarter over quarter. We're not talking year over year. We're talking quarter over quarter. That's how much Agent Force is taking, the growth rate's up insane right now. And keep in mind, as this Agent Force becomes a bigger and bigger component of the business, revenue-wise, ladies and gentlemen, it's going to help out those revenue growth rates in future years, okay? Keep that in mind. It's just math. 50% of Agent Force in Data 360 Q3 bookings came from existing expansion. Salesforce has closed over 18,500 Agent Force deals since launch. Over 9,500 paid deals, up 50% quarter over quarter. Quarter over quarter. That's a 3-month span over a 3-month span. Incredible. Nearly 90% of Forbes' top 50 AI companies run on Salesforce with an average of 4 clouds. Listen, man, you can't, try to explain this to people, okay? You can't move away from Salesforce. It would be a disaster. You're a big company. Everybody's locked in with Salesforce. What are you going to switch from sales to who? Who are you going to get all these products from? So there's 2 stocks that are extremely misunderstood, I found, from the retail investor community. Salesforce and Adobe. People don't understand how big businesses work. They don't understand how these products work and how they're integrated, and that there is no other choice. There is no other option. You can't go with somebody else. It's going to be a disaster. You're like, we've got to get out of Salesforce. We're going to go. Who are you going to? No one. There's a reason 90% plus of Fortune 500 companies use Salesforce, right? It's not just like magic. It's like they have all the products and services you need all in one spot. It's the most cost-effective way to not screw up your company. And so they just keep landing them, And then they come out with new products and services, acquire more companies, have more stuff to sell their customers. Keeps a huge moat around the business, and it's why people are willing to pay elevated PEs for a stock like this over time. You can't leave them, right? AI. Guess what? Salesforce is doing AI. They're going to integrate it for all these companies, and there's going to be no need to go. You think Coca-Cola is going to be like, we got to dump Big Dog, and we're going to go experiment with what are you talking about? Okay, no, that's not the way this works. It's like a fundamental misunderstanding of even business in general and how this stuff works. Okay. Now, as far as Salesforce income statement, grade A banger here. Revenue went to $10.2 billion from $9.4 billion. Gross profit went to $8 billion from $7.3 billion. They kept R&D pretty in check. It was up year over year, but they kept it in check. Sales and marketing, they also kept that in check. They actually brought down G&A, which is incredible considering how much their revenue was up. You're looking at revenue up, $800 million roughly? And to bring G&A down when your revenue goes up almost $800 million on a year-over-year basis is very impressive. Now, they had a big restructuring cost here of $260 million. Compared to only a $56 million restructuring cost. So that hurt their operating expenses, right? But still, despite that, income from operations went to $2.18 billion from $1.89 billion. They also had a gain on strategic investments here that was pretty key, $263 million. Now, in the same quarter last year, they had a $217 million loss. Okay, so that matters significantly. Income before income taxes, $2.5 billion versus $1.7 billion. Now, as far as income taxes, they got hit hard this year. Basically, income taxes for the company around doubled year over year, which is a lot of what we kind of been seeing with big tech in this most recent quarter. It seems like more of a short-term phenomenon going on there. But $219 million basically income taxes they had to pay in the same quarter last year. This one they had to pay $426, so a huge step up there. Net income came in at almost $2.1 billion, just a little under $2.1 billion versus $1.5 billion in the same quarter last year. Diluted EPS $2.19 versus $1.58. That's a grade A income statement there. Very, very solid. And Salesforce looks like it's on its way to have an A plus income statements. I wouldn't be surprised if we start seeing A pluses cross for this company. What is it going to take for it to get to an A plus? Keep the expense profile down, have that gross profit continue to explode up, get to 10% plus revenue growth, which they should very shortly here. And then we can talk about I want to see gross profit growing even as a faster clip than revenue. And I want to see that net income growing at even a faster clip and EPS growing even faster than that. Okay. Now, something important you got to understand about Salesforce here is we're in a revenue growth acceleration cycle for Salesforce, which is one of the most exciting times you could possibly invest in a stock, in my personal opinion at least, when you're at an actual revenue acceleration phase, essentially. And so if you look at the trailing 12-month revenue, it's about 8.3%. As far as current year expected revenue growth, about 8.7%. That's expected. Analysts are expecting to just under 10% revenue growth for next year. I have Salesforce going to 12% plus. 12% plus revenue growth between some of the acquisitions that they just had clear, right? That's going to boost up revenue in a considerable way. Between Agentforce becoming a bigger part of the business, right? A bigger chunk of the business, and the way the growth rates are there, I have them at a 12% plus run rate for revenue growth in 2026. Keep in mind, I think they're going to be able to keep at that 12% plus clip for years to go in the future. So what are my projections for Salesforce here? My base case, I've been doing 12% on average revenue growth per year, 26 through 29. 20% net income growth, so I've grown at a faster clip because they'll be able to keep expenses down while having that revenue growth continue to come in solid. 27 to 32 P is very fair for a company like this. I'm looking at a CAGR right around 20%, maybe 21% for this stock, between now and then. So solid. Bear case, I still make money on this. Bear case, I still make money. That's phenomenal. If I can run a bear case and I still make money, look at the bear case, how depressing it is. 6% revenue growth? Come on, man. Maybe flipping my flapjacks. That's easy peasy. That's a lemon squeezy for Salesforce. With all the acquisitions they do, with the way Agentforce will continue to take off over the next few years, come on, man. And the way everybody's, has no choice but to use Salesforce. If you're a big business, come on. Okay. As far as Salesforce, sometimes it's nice to just have a stock that it's just a moneymaker and just a chill thing. So I'm buying Salesforce right now. I think I'll make a lot of money in the stock over the next few years. And when they go to report earnings, guess what? I can have the TV on, just chilling. I'm not stressed. I'm not worried. I'm just chilling, man. I'm just chilling. And that's what it's like being a Salesforce shareholder. You're just chilling, man. And I think this will be a good money-making stock over the next few years, but time will tell. Alrighty, next up here. What are my favorite fatty paying dividend stocks out there. Okay, so let's get into this here, okay? First thing up here in regards to these dividend stocks, keep in mind over the next 12 to 24 months, dividend stocks could become, let's call it, much more respected than they've been recently. If we look back at the past, really 3 years, no one really cares about dividend stocks over the past 3 years. Why? Well, you could get 4 to 5% on treasuries. You could get 3 to 4% in savings accounts. Who cares about dividends? If you're getting guaranteed 3 to 5% yield, why do you care about dividends? So if you look, dividend stocks actually, for the most part, have kind of sucked the last 3 years, right? But we have an interesting phenomenon going on right now. You want to know what it is? We have treasuries now dropping considerably. This is the past year for the 5-year treasury, right? And you pull up almost every treasury you want to look at over the past year. It's going down all the way to Chinatown. And I don't see this trend ending. The only way this trend ends is if inflation comes back with a vengeance, and next thing you know, we see CPI go 4 or 5%, which the only way that's going to happen is if you have an overheating, booming economy. Do you see an overheating, booming economy happen in the next 1 to 2 years? I don't know. I don't think there's a super high probability of that. That would be interesting if that happened, but I don't know how realistic that is, right? And so the highest probability is treasuries continue to go down over the next 1 to 2 years, which means if you're getting 3.5% on a high yield savings account right now, right? A year from now, that could be 2.5%. That could be 2%. Over the next 24 months, if T-Man gets what he wants and the Fed just keeps lowering rates and maybe they even buy back treasuries and all these other kind of manipulative things to continue to get treasury yields down, next thing you know, you might try to go buy a treasury and you might get 2%. Maybe, right? And so dividend stocks become more and more respected and more loved, right? Now, the next thing you got to keep in mind is dividend payout ratio. Dividend payout ratio matters significantly. So for me, the type of dividend stocks I love, keep in mind, I'm a long-term investor. I'm investing in these companies for years. I'm not buying a stock so I can make the dividend for the next month, the next 3 months. I'm thinking about where these companies are paying for dividends 5 years from now, 7 years from now, 10 years from now, because they might pay a small dividend now. Like, I'll give you an example. I have a friend who used to own a ton of Apple stock, okay? Apple first started announcing their dividend, and back then, I think he was only going to make like a few $1,000s a year on all his Apple shares for dividends. So nothing crazy, like a few $1,000s a year. I think it was like $4,000 or $6,000, something like that, right? And I think we did the math, and if he still had all those shares, I think now he would be making easily tens of thousands of dollars a year in dividends, tens of thousands of dollars a year. Okay. So that's why when I talk about, like, I don't care about necessarily the dividend money I receive right now. I care about a low payout ratio right now in a company that could increase the earnings per share substantially over the next, 3, 5, 7, 10 years. Now we're talking, because I'm thinking about where the dividend income I'm going to be generating from these stocks 5 years from now, 10 years from now, right? That's where we start talking about, like, how much dividend income could I be making 10 years from now? I could be making 7 figures a year in dividends. Like 7 figures a year. A decade from now, if I keep on this game, keep on the grind, stay focused, stay disciplined, keep investing strong, I wouldn't be surprised if in 10 years, I'm making 7 figures plus a year in just dividend income. Imagine that, $1 million, $2 million a year in dividend income. Plugging that money right back into more stocks that are more great opportunities for the next batch, right? That's how you play this game fun. And so payout ratio is very important. I'm looking for companies that have low payout ratios. I'm looking for companies that have a long runway, in my opinion, of EPS growth, so the dividends, they can keep up in those substantially over the next 3, 5, 7, 10 years. So what are some of my favorite? I love Cake. Right now, it may not look crazy. 2.2% dividend yield, nothing too crazy. It's actually less than what you could get on a high yield savings account right now. But what you're missing is Cheesecake has a very low payout ratio. Cheesecake, their earnings per share is likely going to climb in a massive way over the next 5 to 10 years because they have 2 extremely successful restaurant concepts that are about to expand all over the United States of America. And those 2 restaurant locations are going to be, the 2 restaurant concepts are going to be, huge money makers. One's called North Italia, the other's called Flower Child, right? So if I'm thinking about the dividend money I'm receiving from Cake 5 years from now, 10 years from now, it's not even remotely close to what it is today. It's like a whole stratosphere higher, okay? Another one I really like, Nike. Nike, 2.5% dividend yield. Nike is a company I look at in just over the next few years. Our profitability is going to come back in a massive way, in my opinion, based upon the trends I'm seeing in the business, the financials, what Elliott Hill's doing with the business. And so this is another one I'm looking at that has huge likely dividend increases coming over future years. So Nike's one I absolutely love. A company I really like that's a dividend stock, Bath & Body Works. Very simple company. They sell soaps and lotions in the malls and whatnot, right? A dividend yield on this one, 4.6%, much stronger than you can get on treasuries now at this point in time, much stronger than you get on like savings accounts and things like that, right? My one thing I'm mad about with this stock is it started going back up recently. It was like $15 just a week or two ago. And I think recently I was looking at it was already like $19. I'm like, come on, chill. Wynn Resorts. This is one of the most underrated dividend stocks. You look at it right now and it's like, it doesn't seem like a big yield at all, right? Keep in mind, they're holding back that yield massively right now because they're building an insane property in the Middle East. That is a one-of-one property that nothing like that exists over there right now. And so the opportunity there is unreal, okay? So what you're going to see from Wynn's dividend over the next, we can call it 5 years, 7 years, is going to make the dividend right now look like a complete joke, in my personal opinion, right? Because the Vegas properties will keep bringing in insane money. You have the Macau properties that are looking stronger and stronger, right? And then you have that Middle East property. Oh my gosh, okay? They're going to have so much money, they're not going to know what to do with it all, right? Now you look at some of these other stocks that are like huge yields, right? Like, 8% dividend yield, 7% dividend yield, right? 6.8% dividend yield, 5%, 4%. Look at the issue with a lot of these stocks. Their payout ratios are sky high. 91% payout ratio, 80% payout ratio, 82% payout ratio. The one I saw was a low payout ratio was AT&T here, but AT&T's got insane debt levels, so keep that in mind, right? But look at these payout ratios, they're sky high. And a lot of these companies, guess what's going on with them? Their earnings are going the wrong way. Their earnings per share is shrinking, not going up. Their businesses are actually in decline, not growth. That's a problem. Once again, pin comment down there. If you're looking to join us in the private stock group, once you join us in there, we'll send you your Steel membership card to your house, your private group card, your 1000X card, and if you become a lifetime member for the select few, we'll send you your black lifetime membership card. Two major warnings I have to give to all investors out there. There's two things I'm seeing. These are going to be very problematic. For a lot of people, they're going to miss out on some incredible gains. They're going to set themselves up for some potential huge losses. So we're going to speak about that right at the beginning of this video. I have to give a major warning to everybody out there. After we get done going through that, I want to react to 3 clips here. First one is the Wall Streeters kind of talking about where they see this market headed from here. So looking forward to getting into that one. Then I want to react to this one. The next stage of the AI revolution is just starting, says Dan Ives. Going to look forward to hearing his perspective and opinion on this. Obviously, a lot of debate around, are we in an AI bubble? Are we not in an AI bubble? The chips, the stage of the chip cycle, all that good stuff. So looking forward to reacting to that one. And then I want to react to this one. Brad Gerstner went on CNBC this morning, spoke about his views on the AI trade, where everything is headed from here and whatnot. And remember, a lot of their biggest holdings have to do with everything going on in AI, right? TSMC, think about that as the ones making all the chips. Nvidia, think about that's the ones that are actually designing the chips, right? TSMC actually physically makes them, but Nvidia is a designer and the creator of these incredible, obviously, GPUs. And then you have Google McDougal, they're investing in OpenAI, Amazon, Microsoft, Anthropic, Snowflake. I mean, gosh, like Broadcom, like their top holdings are the AI trade. So, he's going to probably be talking his book, but I'm looking forward to hearing the points he makes and then kind of either debunking those or saying, you know what, I agree with what he's saying there, okay? I appreciate everybody joining me as always. Thanks so much for being here. One thing only I need from you. If you could please just smash that like button. It's been over a week since I did a video on this channel, and I hope you guys are excited for this one here today. I'm certainly excited to do this video for you guys, okay? Pin comment down there. That will be if you're looking to apply, join my private stock group, private wealth group, get access to 1000xstocks.com, all of that good stuff, all my course curriculums. Keep in mind, we are closing to new members on December 14th. So today, as of recording this, is December 2nd, so you don't have much time to get in there if you are looking to get in there and take your game up to a much higher level than where you're at, okay? Alrighty, warning number 1 of these 2 I have to give out there, okay? We've got a problem, ladies and gentlemen. I noticed it actually on yesterday's video I released on the main channel called 7 Stocks I'm Buying Now, December 2025 edition. We have a lazy epidemic starting that is transpiring here, okay? And there's a few reasons I believe this is going on out there. But basically, I'm kind of seeing it from some folks like, you know, the most important thing whenever I do one of those videos is hearing how I make a bull thesis together. Like why, as somebody that's been investing in the market and picking individual stocks from 17 years now, right? You're almost never going to find somebody that's been doing it for as long as I have and actually investing their own money, right? A fund manager that invests a bunch of other people's money is a whole different ballgame. This is me investing my own hard-earned money for all these years, right? And so when you have that opportunity for me to go through like why I'm investing in a company, that's the important part. It's actually the exact stock I'm investing is not the important part. It's about the outlook. Like, how do I get to this? Why am I running these numbers? Why am I projecting this? What am I seeing here, right? In an industry and things like that, right? And some people like don't even want that part. They just want the base level stocks. Like, just give me the stocks. Like, you know, and it's just like, oh boy. You know, that's going to lead to big problems in the market. That's going to lead you to likely not making much money in the market. That's going to lead you to likely losing massive amounts of money in the market, right? And then you're going to blame it on somebody else rather than looking in the mirror and realizing you were the problem the whole time, right? And I think there's a few reasons why we have this kind of, I would say, a little bit of a lazy epidemic with some people out there. I would say 90+% of people watching this, you're not in this group, but I would say maybe it's 5%, 7% of people are kind of in this. One, you know, now we're going into winter time. I think it's just something about winter, cold weather. People just kind of start getting lazy, right? They don't want to do research. They don't want to do any work, anything like that, right? And then the other reason is we got to admit it's been easy money since April, has it not? Right? Like think about this. A year ago, the public count is 2.9 mil. Today, it's about $3.7 million. That's incredible. Like what an incredible move over the past year. But to make it even bigger, if we go back 8 months ago, $2.4 million is where the public count was in that downfall, right? So if you bought stocks in March, April, February, like during that whole drama time, I mean, gosh, it's been pretty dang easy to make money, right? You know, from 2.4 mil to now 3.7 mil, the public count's gained about $1.3 million in just the past 8 months, right? It's incredible. So when you have a lot of easy money be made out there, sometimes people get lazy. Don't get lazy. Do not get lazy. No, okay? And then, you know, starting myself out from my very humble beginnings of, you know, making $8.75 an hour in the photo department of Walgreens, right? And before that, working at Einstein Bagels, and then working at Quick Trip and getting my first, you know, decent job at Quick Trip, making $40,000, then $50,000 a year, and like grinding on this thing and start my real estate marketing company, and like, you know, the grind and investing and all these things over the years, right? How have I been able to do that? Well, God, one, right? I mean, if, you know, I could have got hit by a bus in 2009 and I wouldn't have been able to pull this off, right? 2, hard work. Lots of hard work and dedication. I mean, it's incredible, right? And then doing that in an intelligent way, right? I could have just been doing anything for hard work, but I always was thinking like, I'm going to try to maximize my income, try to keep my expenses in check, not have those get out of hand, right? And invest as much as possible and put a lot of my time into what I would call very high income skills, which if you know how to analyze financial statements, invest in companies, run valuations on companies, be able to judge business models is a very high income skill over time, especially as you start to run your numbers up. It starts to become one of the most powerful things you ever learn, right? And so to anybody out there that's a lazy person, listen, I don't like you. My fans don't like you. My subscribers don't like you. None of us like you. Get the heck out of here. You're not one of us, okay? We like to work hard. We like to work smart. We like to work hard, and you know what we do again? We work hard. And we grind. We're optimistic. We believe we're going to build a better life for ourselves than we have right now. We believe we're going to build a better world than what we have right now. We believe we're going to build a better time for our families and our friends than what we have right now. That's who we are. We're optimists, we're realists, and we're hard workers. So if you're a lazy bum, there's no place for you on my channel. There's no place for you with us. We don't like you. We don't want you here. You're not welcome. And that's the bottom line with that, okay? And so don't ever let those lazy bunch ever influence you guys. Make sure you're always willing to put in the hard work. You're always willing to outwork everybody. Because at the end of the day, the winner chicken dinners are the ones that actually outwork year after year after year and stay dedicated. And those people go on to live their dreams, right? And live to, you know, whatever house they want to live in, whatever car they want to drive, wherever they want to go on vacation, whenever they want to retire. They choose it all. They choose it all, right? So that's first part. Second part is, okay, we got another problem going on out there right now. As Warren Buffett would famously say, the stock market's a device for transferring money from the inpatient to the patient. So what we've had transpire recently in the market is people are likely, I would say the average retail investor is probably down from where their portfolio peaked at maybe a month ago or maybe a couple months ago, depending upon what type of stocks are in and whatnot, right? So they're down a little bit. Some people might be down huge. It depends on what you're invested into. If you're invested into like those, super risky crypto companies and all that type of stuff, like you might be down 30, 40, 50%, right? Some of us are down like a few percentage points, something like that, right? But what happens is sometimes you get this like time period in between and people start getting impatient. They're looking for that dopamine high they were getting when the market was going up and up and up and up and up, right? And all of a sudden the market has a kangaroo time. Kangaroo time, we don't call it a bull market, bear market. And a kangaroo time, that's basically the market's going up, going down, but it's not really going anywhere. We're not crashing the market. The market's not uptrending. It's just kangarooing. It's like up a week, then the next week's down, up, down. It's not going anywhere, right? And that's the market we've kind of been in here recently. We're just kangarooing around. And no one knows really, are we about to make a big bearish move to the downside? Are we about to make a big bullish move to the upside? Everybody's just kind of waiting around, right? And so what happens is sometimes retail investors are remembering those dopamine highs and they want to chase those dopamine highs, right? So then they start feeling like they got to start making all these crazy moves and all these crazy decisions and trying to chase whatever is maybe hot at the market at that particular time and things like that. Don't do that. No. Stay focused on the long term in this game, okay? And always remember the Warren Buffett saying, the stock market's a device for transferring money from the inpatient to the patient. So what you need to do, you need to adopt an attitude like I have had for the past 17 years, from a minimum wage worker to where I'm at today. I'm fortunate to be in the top 0.1% wealthiest people for my age bracket in the entire world. I'm very fortunate, right? And all from a little minimum wage worker, clean dishes at the back of the Einstein bagels, right? Had the same attitude for 17 years. Not a dang thing's changed. Listen, I don't care where the stock market goes short term. It's just entertainment. It means nothing. I'm not going to make any of my financial decisions based upon, if I think the stock market is going to go up or go down over the next week, over the next month, over the next year, over the next 2 years. It's all irrelevant. I do not care where the NASDAQ finishes 2026 at. It means nothing to me. Do you know what I do care about? Care about where the NASDAQ finishes 2046, 2036, 2056. That does matter significantly. If the NASDAQ between now and the end of 2026 goes down or up 10% or 15%, it doesn't matter. But I can tell you what does matter is if the NASDAQ triples over the next 20 years and you're not part of that. That matters significantly. So remember that, ladies and gentlemen, okay? Adopt the same attitude I've had. I don't care what happens short term, okay? I'll tell you about a conversation I had with a friend very recently, okay? This friend, he bought a house at peak real estate market, Las Vegas, back in around that 2005, 2006 time frame, okay? And right after that, prices started to plummet in Las Vegas. And prices on real estate went down like over 50%, right? So my friend, he left the real estate market, decided to never buy another house again, just was a renter, right? Ever since. And he, somebody that knows math very well, like very, very well. But he tries to act like math doesn't exist when it comes to real estate. And I said, you could have built a great fortune over the years if you just stayed invested, right? And same thing happens in the stock market like real estate. So I said, okay, here's your example. 2005, you bought a $400,000 home, $80,000 down payment, right? Home nowadays is worth $500,000. So you didn't get much appreciation because you bought at peak market at that particular time. So that exact home in that neighborhood's worth $500,000 now, right? Your equity now would be around $400,000 or so. These are just rough numbers, right? I think the example is actually more bullish than what I have for numbers. Keep that in mind. I said your possible rent for that house in that neighborhood is now about $2,500. So, okay, some years pass by. right? Now we're in 2008. You've been saving. So now that same home dropped over 50% in value. So now those same homes in that neighborhood you could have picked up for $160,000, right? So now the down payment on that's only $30,000. The home nowadays is worth $500,000. Your equity is probably about $450,000, and your possible rent's $2,500. Then comes 2011, so you're saving over the years, right? 2011, $190,000 those homes are up to in that neighborhood now. Down payment, $35,000, home worth $500,000, equities now about $400,000 in that particular home. Possible rents $2,500. 2014, save up some money. Those homes are now $250,000, down payment $50,000, homes worth $500,000, equity of that home's about $350,000, possible rents $2,500 a month. 2017, those homes are now valued at about $300,000, down payment $60,000, homes worth $500,000, equity probably about $250,000 on that particular house, $2,500 rent. 2020, you buy another one, those homes are now priced at about $350,000, down payment $70,000. Home worth $500,000, equity about $200,000 in that one, $2,500 a month of rent in today's money, right? 2023, buy a $500,000 home. Those homes are now valued at, right? Down payment $100,000, home worth $500,000. Your equities are about $100,000 or so. Possible rent $2,500. So in 2025, you have equity between all those homes because you just stayed in the real estate market. You didn't sell, you didn't foreclose, you didn't short sell, anything like that, right? You stayed in the real estate market. You kept buying over the years, and what do you have to show for it? $2.2 million of equity. $2.2 million of equity, and I think my numbers are low here. Your possible monthly income from those rental properties is $17,500. Your possible rent income on a yearly basis is $210,000, right? Now my friend tries to argue back. I say, you refuse to use math on this subject. $425,000 is what you have invested over that time, right? And keep in mind, it wasn't in one lump sum all 20 years ago. It was like over the years, right? $425,000 into $2.2 million is amazing, right? I said it throws off 6 figures plus a year in profit, right? When you take into account like what you might be still paying on those mortgages, when you take into account like, stuff you have to fix around the properties and things like that, maybe a rental management fee, you're still clearing like $100,000 plus in profit a year, right? I mean, it's incredible, right? And so the same exact thing I just ran you through with the real estate example, that happens in the stock market. You stay invested and you make fortunes of money over time, right? You stay invested. And when you get those crashes, corrections, all that stuff happens, you have to be ready and willing to buy, especially when it's ugly. And so for somebody like myself, because of the way I think, my attitude, it's easy. Didn't matter when I was broke, as in I had $1,000 to my name or $2,000 to my name. Didn't matter when I was middle class, because I'm one of the few people that's been in poverty on food stamps, and I've been middle class, and I've been rich, and then super rich. So I've seen it all. Like, there's nothing anybody can tell me because I've lived all the stuff. I've been the food stamp person. I've been the middle class person. I've lived the whole thing. And I live to be super rich. Like, I've seen it all. And I'm just telling you, like, my mentality is how you get to this place. I don't care what happens short term. I'm going to take advantage. I'm going to add to great assets all the time. And when they're underpriced and undervalued, I'm going to add extra aggressively. And that's how you climb the ranks. From somebody in poverty, maybe on food stamps, to, okay, now we're getting to the middle class. And if you want to keep working, you want to keep climbing, you can go from middle class to rich. And if you want to keep climbing after that, you can go from rich to super rich. And then if you want to go from super rich to like the top 0.00001% to like the billionaire class, you can keep going. Like, it's as far as you want to take this, you can take it. That's up to you, right? But that mentality is massive. Let's react to some things. Hope you guys enjoyed that.
The 10-year continues to stay around 410, and there it is, right on the button. Bitcoin having a day, bouncing 6%. Tech is leading, Nvidia's up, Oracle's up, Palantir is as well. Josh, the final month of this year underway. How do you see things today?
So I was talking to somebody last week about what's like the most obvious thing that you think is going to happen that people still aren't expecting, even though it's obvious, like kind of joking around. And the truth is, they're going to buy these Mag 7 stocks. And I know how badly people want there to be a new narrative. I know how sick and tired people are of seeing the same 10 stocks at the top of the leaderboard quarter after quarter, year after year. And I understand how people went overweight, healthcare and energy and staples and some of the other areas that started to rally in late November as the AI story started to get a little bit shakier. But like in the end, these are the biggest, most liquid stocks. And contra the bubble narrative, they're not even expensive. Meta is a 22 times forward PE. Like, what are we talking about? You're going to tell me Costco at 45 is cheaper? Nvidia is the second cheapest stock in the Mag 7. It's got a forward PE now at 24. And I understand all the stories about competition, et cetera, not dismissing that. But again, this is the best company on earth, and it's 24 times forward earnings, a multiple you have never been able to pay for a name with execution at this level. So I really feel, Judge, we had this huge momentum swing on November 20th, only 4.6% of all the names in the XLK sector spider were above their 10-day moving average. Today, that's 86%. That's the highest since July. These names are being accumulated, and I feel like second verse, same as the first. Everyone gets how this year is going to end. I know people want a different narrative. I just don't think you're going to get it.
Joe, it sounds a little bit different than...
So listen, okay? What JB just said there, 100% on. You know, you look at a Meta versus a Google or versus a Costco, like, what are we talking about here? Why would you pay 45 times for Costco versus 22 for Meta? It makes 0% sense. 0%. Meta's got a way better business model, like dramatically better, right? You can't disrupt those guys. Like everybody's tried, right? Costco, you could easily disrupt them. Amazon could disrupt them tomorrow if they want to. Like they really could. They would be very expensive. It probably wouldn't make the most sense for Amazon to do that. But if they wanted to, they could just offer all the products they do at the same prices. Amazon could do that tomorrow, right? And have it all delivered instead of having to go to the store. But is Amazon realistically going to do that? No. They might slowly push into that space over the next 5-10 years. But it's not like they're going to be like, let's go take out Costco, because it just wouldn't financially make sense, right? So with Meta, like who could just come in and take out Meta? No one. That's the thing. Somebody could come in and take out Costco. No one can come and take out Meta. It's impossible. You can't just be like, oh, we're just going to launch a service and it's just going to have like 3 trillion people on it. Like, no, it doesn't exist. Okay. And so like Meta's business model is unbelievable too. They don't have to worry about selling retail crap for pennies on the dollar. They run an ads business that's incredibly profitable. The business makes so much money that Meta doesn't know what to do with it all. So they spend it all on Nvidia chips. You know, I don't even know what to do with all this money. Like, it's just ridiculous, right? It's pouring in. And we're talking about Meta that had 26% revenue growth last quarter. Like, you know, Costco's not even in that same stratosphere. So, you know, when you try to outsmart the market and you think like, oh, you know, Costco might be the better play because, you know, people are rotating money to blah, blah, blah. And people are scared of the AI trade. What are we talking about here? And like Meta's returns are going to make Costco's returns over the next 5 years look like small money, right? Like, it's just crazy. So, but that's what people do. That's what people do, right? It is what it is.
Looking for.
Well, I'll tell you this. I love that Josh is targeting the conversation towards the Mag 7, because I think that's the right place for the conversation to be. And I think when we turn the calendar to 26, I told you yesterday, I think 26, it's about quality, not momentum. Well, the Mag 7 is the essence of quality, Scott. And I think it's going to look very similar to what it did in 23 and 24. You know, Josh is talking about consensus as you move into the end of the year. The consensus I keep hearing about is about this concentration and about the concentration being a risk and how you want to broaden out. I think that concentration remains in place in 26. Look at what is going on with the Mag 7. Look at Apple. Apple is up 40% since August 5th. Loop Capital today raises the price target from $3.15 to $3.25. I read the note. They did not mention once the ability to deliver on Apple Intelligence, which we know this company is behind on. So you tell me, is it priced into the stock or not that they're going to succeed with Apple Intelligence? Because I'm not so sure that it is, but I'll tell you what, a lot of people want to own Apple right here. I made it my final trade yesterday. I know Josh made his final trade last week, and it continues to move higher.
Why are you skipping past the the month of December. You're talking about 2026. I think people want to know if we're going to have a pretty, right? I mean, Josh was talking about the rest of this year. You bypass that. You just start talking about 2026.
Look,
you have to get your notebook back of all the things I say about you. You keep score.
Let me write this down.
You're going to have to write this down now because you bring it out. Like, what about? That's not what he's talking about.
Here is the notebook.
He's not talking about
He
that.
is talking about the Mag 7, and the Mag 7 are going to be important moving into 26.
You're talking about 2026. What's going to happen in December?
So let me respond to you by saying this. Beginning Labor Day, I said we would have a chase for performance into the end of the year. And I think we'd agree to a certain extent that we've had it. But now we're basically less than 30 days away from the calendar turning, and you're not going to like my answer. I have no idea what's going to happen here in the final 3 weeks of the year, where liquidity is coming out of the market, where volumes are getting lower and lower, where we have all these different dynamics like an inflation reading on Friday, a Fed meeting, maybe a hawkish cut, you've got yields rising. So I'm sorry, I don't know where we're going over the next 3 weeks. Are we going to complete to chase for performance? Maybe we are. I have no idea. If we do, I'll be happy about it. But I am more focused on how do I want to think about investing in 26.
He punted as bad as the Giants kicker.
Oh my God,
last night.
That was
Okay, yeah, that was a situation. To be fair, though, listen. Respect. I actually respect that he said, I don't know where this market's going in December. I respect that. You know, like if you don't have any belief in where the market's headed this month, why would you have a take on that? Like, then you're just throwing darts at a dartboard, right? And you could say making calls on the stock market in the short term already is like that. But especially if you don't have a strong opinion, like if there's something specific that you're like, I see this being a problem, blah, blah, blah. People are going to freak out over this. Okay, like I could get it. But if he doesn't have anything that makes him say, oh, for sure the market's moving up or moving down, why come up with something? You know what I mean? Like, I actually respect that Joe Terranova right there basically did punt it. I respect
Joe just put his foot in the ground.
That was awful.
When he was approaching
I
the
don't
ball.
know. I don't know where we're going in the next 3 weeks.
Maybe it was a punt and not a field goal, but nonetheless.
You know where we're going in the next 3 weeks?
Well, look, here, I'm on the other side of where you are. I think I just heard you say, and I need to confirm this, that liquidity is getting tighter. Because the opposite is what I see, both with quantitative tightening coming to an end and the shutdown.
I'm not talking about monetary liquidity. I'm talking about the liquidity in the market itself.
They're the same. They're the same.
You see what's going on in crypto? You see what's going on with SoftBank?
Okay, so crypto is the aberration to what I'm saying. Liquidity, let me just start with this. Liquidity has
an effect on the market.
Liquidity has come back to the market, all right? We had the shutdown end. Treasury is putting money into people's bank accounts again. We had quantitative tightening end yesterday. Liquidity is picking up. Your point about crypto is well made. Yesterday was an aberration. And you see crypto is up today. That's what it should be doing in response to both increasing liquidity and an increasing risk on sentiment, which I agree with Josh with an asterisk. I agree with Josh that Mag 7 are absolutely going to perform going into year end. But what I'm also seeing, this is the asterisk, is a lot of things that have nothing to do with AI are performing well right now. I mean, just picking names out of a hat, like Delta Airlines, Wynn Resorts, things that we talked about yesterday. But still, these have nothing to do with AI.
You were going to go there.
It's just what I'm seeing, Scott. I mean, it's not. Mag 7 should do absolutely fine into year end, but so should the markets overall.
Can
I please get a 1 year chart of RSP?
Yeah, you definitely can, but you're going to wait.
Yeah, but 1 year has nothing to do.
I want to hear from
what we're saying.
I want to hear from Shannon, who hasn't had a chance to speak yet. So just bear with me for a minute. Shannon.
I actually want to pick up on one of the points that Jim has been making, in that the areas that are actually starting to perform a little bit better are around the consumer. I think there has been this overhang in terms of the impact of the shutdown, the impact of continued price increases, the compounding, the pressure that the consumer has been under. And what I've been talking about over the last month or so has been perhaps that pressure being eased in terms of retailers, in terms of travel. We're seeing, Scott, if you want to look for other pockets of strength outside of AI, we're seeing this expectation of stronger growth next year. We're seeing the potential for perhaps a better holiday spending season. And I think that that's pervading other parts of the market where investors, to both Joe and Josh's point, the easy button, the proverbial easy button for AI is the mega caps, right? It's the Mag 7, and people are going to continue to buy that. However, I think what is important is that this broadening out is starting to pick up some steam in terms of there are areas where people have been very hesitant or reticent to buy.
It did in November. That's why everything but tech was working well. Healthcare, one of the areas people were afraid to buy anything because it didn't work for a few years. There are many other sectors that, the broadening out worked in November.
But that doesn't refute the fact that we could still get this chase for performance to the year end. And if these AI stocks are available, why wouldn't you want to continue to buy them? Because they're willing to continue to spend, they're willing to continue to compete, and they are helping to.
I'm not arguing with that.
They are growing that footprint, and so this AI enabler trade is going to continue into 2026. What I would caution the viewers is that at some point it's going to be necessary to shift your focus to strong balance sheet, cash flow generative adopters of AI, and that's where the next phase of this trade is. So through the end of the year, because I know you're going to press me on this, I think that the S&P 500 is going to perform strongly. I think that tech is going to lead the way, but I think going into 2026, if you aren't trying to figure out where the next leg of this trade is, I think you're going to be behind.
Okay, so what are my stance on that, right? Here's the deal. What she laid out there, that is how Wall Streeters think. Trying to think about where's the either next move at or where's the current move at, how much longer does it have, these sorts of things, right? Moving money around, rotating. For the next 3 months we're going to be here. For next year we're going to be here. As somebody that has my investing discipline, that is a long-term investor, right? That believes in what we believe in here. Focus on the long term. Income statements, balance sheets, what companies are going to do well over the next 5-10 years in regards to their financials. Not what stocks are going to be the next ones in favor because they're adopting AI technology or they're not, or like this is the new play. At the end of the day, keep it simple. Run your projections over the next 4 to 5 years. If your projections, when you run your base case, you're going to get if you get a 15, 20, 25% CAGR, you're looking pretty dang good, right? If even your bear case has a positive CAGR likely over the next 4 to 5 years, you're looking really good, right? And so play that game. Don't try to play like the rotation of money from here to here. Dan Ives next up.
Investing 20% upside for the tech sector next year. When we say tech sector, define it. All of the NASDAQ, Mag 7 names, what are you seeing?
I think big tech, if I think about like big tech in the AI trade, that's probably going to be up anywhere from 20 to 25%. But I think it's really the AI revolution stocks. What I view as sort of the winners, up 20% at a minimum. Look, it's my view, this is just starting the next stage of the AI revolution. I mean, all of our checks are showing, even in the last 3-4 weeks, about 20-25% of deals are actually accelerated from the hyperscalers. So that's why I view it from software to cybersecurity, the infrastructure. I continue to view it as, this is just the beginning of the monetization of the AI revolution.
What do you make of these deals, though, excuse me, that Nvidia has been making in terms of investing in a partner, which is basically a customer? Because in this case, the deal is that Synopsys will use CUDA, and so we'll become a paying customer. So they're investing $2 billion in stock in order to gain this customer. At some point, do you question that, or is that all fine?
Look, I mean, as somebody myself that covered tech, late 90s vendor financing, so obviously, worries, is that a red flag? Look, I view it as this is an AI arms race in terms of everything that's playing out. So for Nvidia, for OpenAI, for what we see AMD and others, like they're putting stakes in the ground. I view it as for every dollar they spend, they're getting back $8 to $10. Now, in the near term, there could be questions until it plays out. But I think we're going to look out 2, 3, 4 years at these deals. And that's how, like Nvidia, they're going to continue to be like, that's the one chip in the world that's fueling the AI revolution. And I don't see that slowing down. That's why I love everything Jensen's doing.
Were you surprised? I'm curious that Synopsys didn't trade better today, understanding that stock went from 650 to 420 in a straight line. That announcement today, $80 billion company, $2 billion investment. It traded well. I thought it traded a lot better than it did today.
Yeah, look, I think, if you look at Oracle, the $100 dip ever since OpenAI. The view almost like good is bad. Like being associated in Nvidia, OpenAI, is that like a too big to fail moment? But I think we're going to look out. Like, I'm surprised the stock didn't trade higher. I think there's something where I view that as more of an opportunity. Given my view, like that's one of those sort of second, third derivatives of this AI revolution trade into 26.
So Dan, on the peripheral,
I'll tell you where this is actually going to go bad, because no one's actually looking at it from the right angle. Everybody's worried about bubble and like Nvidia investing in these other companies, and maybe Nvidia's just trying to goose orders and things like that. I think they're missing the much bigger thing that's at play here, in my opinion. If you want to look for trouble, if you want to look for a fire, I'll tell you exactly where the fire is going to come. You're going to see it a few years from now. You're going to see it right now. You're going to see it a few years from now. Nvidia's taking stakes in all these companies. It's going to end up being an issue when it comes to the government. And so what you'll see play out, probably not in the Trump administration. The Trump administration, I think, is going to probably look the other way on this. But either the next administration or the next administration, they're going to do a full investigation into Nvidia. And oh my gosh, they were investing in all these companies. Then these companies also then bought Nvidia chips. And this was like antitrust and monopoly type stuff and these crazy tactics and all this. You wait on it. Problem is, some of you guys are still going to be watching me if I'm still doing YouTube many years from now. When we get another administration or the next administration, this actually happens and plays out. You'd be like, I remember you called that back in December 2025, Jeremy. I remember you called that. So Trump administration likely will look the other way for the next 3 years on this, but you just wait. Your government's going to come down on all this. But by that time, here's the thing. It's going to be too late. Nvidia's already going to have made all the money, so they'll get slapped on the wrist with some fine. Maybe they're going to have to divest their stakes in a bunch of these companies whenever that time comes, and they're investigated for 10 years from now or whatever, right? It'll be too late. Like, Nvidia already made so much money. They've already made a bunch of money on their investments, so they'll have to sell out of those investments, and maybe they'll make some law changes in the future around being able to invest into too many companies. Who knows? But government will end up coming down on Nvidia in the end. But that's not happening short term, though.
Look at Palantir. It's been a name that you've been bullish on. It's been hammered right after earnings. Is this one that you double down on, given the valuation, where it's just so outsized for everyone to actually look at it and think that they want to buy it even cheaper than it was, but it's not really substantially cheaper? Do you buy it here?
I mean, Steve, to me, you triple down. Because it's my view on Palantir. I get it's expensive today, but in the next 2-3 years, I think there's $1 trillion market cap, because 20-30% of all the deal flow, the trillions of dollars being spent on the use cases, I mean, they're playing a different game in terms of any AI use case in the enterprise. Palantir's first call. So that's still not reflected in the stock, and I get it's super expensive and it's become sort of an emotional bull-bear debate. But I think this is a stock that, we've talked about 200, 225, 250 in terms of my view where it goes.
First off, stock price isn't going to do anything in the short term. Anything's possible in the very short term with the stock. But over the long term, companies are valued by how much. Always remember this, ladies and gentlemen. Over the long term, companies are always valued by how much net income they throw off, okay? Over cash flow, over revenue, over everything, okay? That's how you value long term. How much you actually bringing home? Is the bacon actually there or is it not there, okay? So, to command a $1 trillion valuation, if you have a 20 PE on that stock, which is a fair market multiple, you need to be bringing in $50 billion a year in net income. There's a big question mark if Palantir ever gets to $50 billion of revenue. I'm not talking $50 billion of net income. There's a big question if Palantir ever gets to $50 billion of even revenue. And if they get there, it's going to be a long time from now. You do realize Palantir is only doing a few $1 billion a year of revenue. And that's growing rapidly, but it's like, even you run the numbers and it's like, dude, to get to $50 billion of revenue, it's going to take them, deep into the 2030s. And that's if they keep a very strong growth rate on for that entire time, which that's, we got to remain and see what happens in regards to that. So, then you got to say, okay, how do we get to $50 billion in net income? Gosh, man, Like, it's brutal. But, anything can happen with stock price in the short term. Keep that in mind. Alrighty, Brad Gerstner.
Holdings that include Nvidia, Amazon, Alphabet, OpenAI, Microsoft, lots of others. So let's talk a little bit about what you're seeing in the tech economy, in the broader economy, and where things are headed. Because there's been a lot more volatility lately.
Yeah, I happen to think that volatility is good, and let me tell you why. Yeah. We're coming up on the 3rd anniversary of ChatGPT. We've come a long way fast. You've seen Nvidia add almost $200 billion of revenue in the last 3 years. Yeah. Truly extraordinary. Transformational phase shift, super cycle going on in our economy. It added 100 basis points to GDP this year. But remember, this year we had 225% drawdowns in Nvidia. It hit $90 earlier in the year on the DeepSeek scare, right? And so there's going to be volatility when you're early in these phase shifts, right? That wall of worry prevents the bubble that everybody's worried about. And when you look at the multiples today, take Nvidia, for example. I think it's trading at 23, 24 times fully taxed earnings on next year's numbers, 18 times on 27 numbers. That is not the stuff that bubbles are made of. Right, I think the rest of the Mag 7 all trades somewhere between 25 and 30 times. Maybe Meta's at 21 times earnings. So to me, taking a little of the gas out, having some of these conversations and debate, very healthy. And what I see out there right now is a tremendous amount of progress on the model side. But I think the diffusion, the rate at which this transforms lives, both consumer lives and enterprise, that takes time. And that's what we're seeing play out. We're seeing the debates about Nvidia versus Broadcom, Google versus OpenAI.
Well, yes, and that's what I was going to get to. Is the new version of Gemini better than...
You want to know something funny? I've had some thoughts about buying a stock recently. A stock I used to own. You know what it is? Nvidia. I've had actually serious thoughts about buying Nvidia back. And the reason being is I was thinking about it from almost like a hedging standpoint, where I'm like, let's say, because a lot of my biggest dog positions are Meta, certainly, Amazon, Google. It's like, what if they just keep taking the spend up to stratospheric levels, right? Obviously, I have exposure through AMD, but I'm like, what if I had exposure through Nvidia as well? So let's say, like Amazon, Meta, Google, they just keep going crazier and crazier with their spend, right? And I was thinking like, and they're just spending even more money with Nvidia. And let's say those stocks kind of, don't do too well over the next few years because their spend's so out of control. And let's say they're not quite seeing the revenue growth, but they just keep spending with the Nvidia. I'm like, dang, it could be a pretty decent hedge. And let's say those companies are seeing their revenue go up and they just keep increasing that spend heavily with Nvidia and with AMD as well. But I was just thinking like, maybe I could make money with Nvidia as well, right? So, and they are bringing in a lot of money. They're bringing in so much money, they don't know what to do with it. They don't know what to do with all the money. It's insane. And so although growth rates are going to slow with Nvidia, they're still just going to be bringing in so much flip and flapjack and money. It's ridiculous. Like, what do you do with all that money? Do you know what the net income of Nvidia is going to be next year? Oh my gosh. Oh my gosh. You know what I mean? Like I'm running the numbers in my head on Nvidia's net income next year. And I'm getting like ballpark 200 billion. I'm running numbers in my head right now. I'm getting ballpark $200 billion of net income for Nvidia next year. Ballpark. So let's say 170 to 230, somewhere in there, right? Maybe 150. Maybe worst case scenario. What are you going to do with $150 billion of net income? You know what I mean? Like, massive share buyback? Like, or just keep investing in other companies so they keep buying more of your chips so then you make even more money? Like, dang.
GPT.
It's terrific. It's terrific. Remember, a year ago, we were counting, Google out of the equation. I've said on Twitter and otherwise, we own Google. Yeah. I've said it's very difficult to pick a winner here. So you can own them all. You can own OpenAI and Anthropic. You can own Google and Microsoft. And I think at this phase, you probably should do that. I think Google's done an incredible job. Remember a year ago, Satya was saying, we're making Google dance. Mm-hmm. I think Sundar is making people do a little dancing today. Mm-hmm. And so that's part of the competitive dynamic that I think is great for the country. It's what's going to keep us on the leading edge.
That's great for the technology spending. There are a lot of questions about what this means for the business world, too, for enterprise. Yesterday, Jensen Huang was on Squawk on the Street with Jim Cramer, talking a little bit about that deal that they did with Synopsys. And that was pretty interesting to hear how it's got to be able to be used by these big industrial companies to be able to really make the next steps. And Jensen made a point that I thought was really interesting, that 90% accuracy is okay if you're dealing with consumers. It is not okay if you're in any of these big enterprise issues.
That's right. Think about it this way. The machine that builds the machine. Right? That's really what he's talking about. We saw that with Tesla and Elon, right? Elon used to talk about we can't get to where we need to get to with electric cars until we first build the machine, right? A totally new way to manufacture cars that can drive down the cost. And that's what you see Jensen talking about, for example, in the design of chips, right? That you really imbue the entire industrial economy with AI. And all of those benefits lie before us. I think we're heading into a very significant productivity boom. I've talked about the golden age of margin expansion for a lot of industrial and other companies in America that can simply do more with less. Our economy is going to see that productivity tailwind. But it's never a straight line up and to the right, Becky. And so I think for people who are watching it, you've got to anticipate we're going to have volatility. I remember early in the internet super cycle, Google would be up 5 or 10% a day. Remember when Facebook went public? Right, and then it broke $20 a share. Right, it broke issuance because everybody was worried, could they possibly monetize on these mobile devices? When you're early in these super cycles, there's a lot of questions, and that's where we are today.
You're talking about the winners that came out of that. There was a lot of volatility in Pets.com too.
For sure.
And by the way, those companies went bust.
And there are going to be companies in this cycle that go bust. There are 1,000 companies in Silicon Valley valued over $1 billion that are trying to raise money. It's not going to be equally easy for all of them, right? But I think that's part of the process of creative destruction, right? It's okay that that some companies aren't going to make it.
We talked earlier this morning about some comments from Masa-san, who said that he didn't want to sell his entire Nvidia stake, but he had to in order to be able to put it into OpenAI. You've got bets on both of those companies.
Yes.
What do you think about that?
I wish my bet in OpenAI was as big as Masa's, but
would you sacrifice your Nvidia bet for it?
No, like I said, Nvidia's been an extraordinary winner. We invested in Nvidia in December of 22, right after we saw ChatGPT. The stock's up over 10 times. 10x over that period of time as the revenue went from roughly $30 billion a year to over $200 billion a year. And they just told us that we should expect a run rate by the end of next year of $100 billion. And this is at the same time that Broadcom is doing extraordinarily well. What Hock Tan has done partnering with Google to build out TPU 7 is extraordinary. That's going to force Nvidia to be even better. So I think we've seen a lot of winners, and you can see from the logos that Altimeter owns, our choice has been really to own a lot of the best names that are benefiting from this super cycle.
We also have talked a lot about,
and let's be clear, it's a smart way of playing it. It's the way he's playing it. Maybe you give up some potential upside by not going all in 1 or 2 or 3 names, but you don't want to get too over leveraged to a position in this, obviously massive movement here. And let's say they're not the big winner chicken dinner. Let's say Nvidia starts having a lot of their market share eaten into starting in 2027 from AMD and their chips, and also from Broadcom and some of the we can call almost like private label type chips, right? Might not happen, but it's good to have exposure to other places, right? It's good to have exposure to other places just in case that one company or 2 companies you're in don't quite make it. That's why I stay invested. GVD 1, 2, 3.
And the volatility you've seen there. Maybe volatility is not a surprise, but when you layer on leverage on top of that, as strategy has done, it does raise a lot of questions. Do you play in leverage in your holdings?
No, we run very, very limited. As a hedge fund, we run very limited leverage. We certainly would not be levered Bitcoin. And in fact, I've commented on Twitter about it with respect to MicroStrategy. It works incredibly well on the way up. But I said I didn't understand the strategy. And when I can't understand something that somebody explains, time after time after time, that's a warning sign to me. And I think you're seeing kind of some of the unlevering that is occurring. Bitcoin this year is down 10%. Gold is up 50 or 60%. I hope we can dispel the myth, right? One is a risk asset and one is not, right? And so it doesn't mean that you shouldn't own Bitcoin. I own some Bitcoin. And I might be buying a little bit more, as it comes down.
What he just laid out, perfect. If somebody wants to own Bitcoin, respect. Do what you want to do. But don't try to make a case that it's not a risk-on asset. That's where we run into trouble. Because listen, Bitcoin is one of the biggest risk-on assets out there. If people want to take risks, they buy Bitcoin. They don't want to take a risk, Bitcoin sells off in a massive way. And it's been proven time and time and time again over the last 10 years now at this point in time, right? Once again, if you're looking to apply, join Private Stock Group, Private Wealth Group, get access to all my best course curriculums, exclusive weekly videos to see the moves I'm making each week, Discord chat access, all that good stuff. Pin comment down there, click on that, fill out a form. Let's get you in there ASAP because we're running out of time. December 14th is the last day to join us in the private group. We're closing it down to new members December 14th. Today, some incredible opportunities I see out there in the market. We'll get into where I think these stock prices are going long term, in my personal opinion, all that good stuff. Do keep in mind I'm a long-term investor. I'm investing into these companies to hopefully make a lot of money over multiple years. I'm not just trying to make a penny here, a penny there over the next few days in regards to these stocks. This video, I've been prepping this for basically the entire day, so I just need to jump straight into it. We have a lot of stocks to go through, a lot of things to go through in this video, a lot of business models to go through. Only thing I need from you guys, if you could please just smash that little like button. For everybody that's already done that, thank you so much. And if you have not already hit that little like button, that's all I need from you. If you could just hit that, smash that little like button, that'd mean the world. Additionally, if you want to be subscribed to the channel, you can certainly subscribe. We're now at 906,000 subscribers. Additionally, my private stock group will be closing to new members on December 14th. That's less than 2 weeks from now. If you want access to join us in there and apply for access, that will be the pinned comment down there. That's access to all my course curriculums, private Discord chat, 1000x stocks, exclusive weekly videos, the moves I'm making in my massive Fidelity account, all that good stuff. Pinned comment down there. Once again, it is closing to new members on December 14th. Okay. Alrighty, guys. First one of these 7 stocks up here is Salesforce, CRM. This is a $232 stock at the moment. This stock, I believe, will 2x to 3x over the next 5 years. Now, the stock price has done very poorly over the past 5 years. It's down 5% in the past 5 years. So if you bought this stock 5 years ago, you haven't made any money. You've actually lost a little bit of money in regards to this one, but all I care about is the future. I don't really care about the past in regards to these stocks, right? So Salesforce, a lot of people don't really understand Salesforce, especially like the retail investor community. Wall Street understands it well because a lot of those folks are from the big corporates, right? Big banks, and they probably use Salesforce for their products. So they understand it well, but I feel like a lot of retail folks don't really understand Salesforce business model, why this is such an incredible opportunity over the next few years, things like that. So I asked AI, I said, explain Salesforce to somebody like they're 5 years old, okay? And it did a phenomenal job, actually. It did a better job than honestly I could do explaining Salesforce business model. Like, you're going to understand, if you have no conception of Salesforce business model, after the next 2 minutes, you'll all of a sudden understand, like, oh, I get Salesforce. Okay, that's why. Salesforce is a company that rents out special computer programs to other businesses to help them keep track of all their customers and sales. Its business model, a subscription-based service, like a monthly membership, where companies pay to use software instead of buying it all at once. This is also called cloud-based software, meaning the programs run on the internet and not on a company's own computers. How Salesforce works. It's like a super smart address book. Imagine a company has thousands of customers. Many of these companies that use Salesforce have millions of customers, tens of millions or even hundreds of millions of customers. Keep that in mind. Imagine a company has thousands of customers. Salesforce helps them write down every customer's name, what they bought, and when they last talked to them. It helps make money. By keeping all this information in one place, companies can see what they're selling well and what they could do better at to get more sales. It's more than just sales. They also have programs to help advertising, customer service, and building online stores. So really, it can be the backbone of a business. Think of it like that, especially for a lot of medium-sized businesses and certainly large businesses. It's customizable. Businesses can pick and choose the parts of Salesforce they need, like a Swiss Army knife, for their business problems. Keep in mind, the amount you pay to Salesforce is very small. Like if you're a large company, you pay Salesforce, I don't know, $5 million, $10 million, $15 million, $20 million a year. It's actually a very small amount compared to what you're getting out of Salesforce for basically running the back end of so much of your business. It has a built-in marketplace. Salesforce also has a special app store where other companies can build and sell extra tools for the Salesforce program, like adding a new feature for a pizza shop to count pepperoni. The business model, rent instead of buy. Companies don't buy the software, they pay a fee, usually every month to use it. This is called subscription as software as service, SaaS. And you guys will hear me throw that term around a lot in videos, SaaS. Pay as you go. As businesses grow, the needs for features also grows. Companies can pay more as they add more subscriptions with Salesforce. Always up to date, Salesforce takes care of updating the software and making sure it's secure so businesses don't have to worry about it. If you have a large company, you're going to end up using Salesforce and you're going to be signed up for a ton of their different programs and services, and they're going to run a ton of your back-end business. It's as simple as that, okay? If you're a mid-sized business, good probability you're also going to use Salesforce. If you're a little company, like a little, 1 to 10 person team, you might not use Salesforce. It might not be relevant to you. But I can tell you, once you start having hundreds of employees, thousands of customers, tens of thousands, it's a good probability you're going to end up using Salesforce. It all ends up leading to Salesforce. Okay. Now, the other question you got to ask yourself, why has the stock been dead for 5 years? Okay. I think that's a fair question. Well, here's where the issue came in if you bought this stock 5 years ago. Valuation. People do not like to pay attention to valuation when times are good, when the market's good. And then they realize, oh crap, I probably should have paid attention to valuation. So what we had going on in 2021 was we had a stock market that kind of was valuing anything sky high. It was a blow off top in regards to equities, in regards to growth stocks, even profitless companies. Like it was just a crazy time in the market in 2021, right? Coming off of Rona, the shutdowns, all that stuff. It was just nuts. Stimulus checks. It was crazy. 0% interest rates. It was a whole situation. Okay. So companies were trading at very silly valuations. And what happened to Salesforce is look at the PE ratio Salesforce had on it. Keep in mind, the market in general usually trades at around a 20 PE, maybe just under a 20 PE, okay? Salesforce, 76 PE, 60 PE, 50 PE, 47 PE, 96 PE ratio, 164 PE ratio, 155 PE ratio. It was priced to perfection plus some. And that's the warning I have to give to everybody out there buying super high PE stocks. That's why you look at something like a Palantir, Tesla, stocks like that. I'm actually not bullish on those stocks for the next 4 or 5 years. And it's not because I expect those companies to be doomed or they're not to do well. It's just they trade at such sky high PE ratios. It doesn't really matter what they do. It's going to be hard for those stock prices to go up over the next 4 to 5 years. This is so important. Has Salesforce's business model collapsed over the past 5 years? Absolutely not. It's better than it's ever been. Their revenues are massively more than they were 5 years ago. Their profits are massively more than they were 5 years ago. Everything's night and day better for Salesforce. Their opportunity, their growth, it's incredible. But yet, the stock has, 5% negative return over the past 5 years? Because people were willing to pay crazy P ratios in the past for the stock. But guess what? That is no longer the case. The trailing 12-month P is 33 on this stock. The forward P is 28. The 2-year forward P is 18. Now we are talking about a Salesforce that is attractively priced. So if somebody buys in today, they could be likely looking at great returns over the next 3 to 5 years. Versus had they bought in 5 years ago and you have a negative 5% return because you paid 165 PE for this stock. P ratios, you hear me talk about it time and time again. I'm dropping gems for you. This isn't just a video about stocks. This is a gem dropper. PE ratios end up mattering in the end. And they have significant weight on if you make money on a stock over a 3, 5, and 7 year basis. They have no weight on a 1 to 5 month basis. They have no weight on a 1 to 5 week basis or a 1 to 5 day basis. But I can tell you, over a multi-year period, P ratios end up mattering. And the people that buy at sky-high P ratios, they end up looking and they're like, crap, man, maybe I shouldn't have gone that crazy with it. right? No, here are my bull case, base case, and a bear case for Salesforce and what I'm expecting the stock to do. No, if I run a bull case on a stock, this is looking at the next 4 years for the company, and I can get a CAGR, let's call it mid-20s, I'm looking really good. My base case, I like that to be around a 20% CAGR. And then if my bear case can also be a positive return, I won. It's like I have to buy that stock, basically, okay? And so what I find with Salesforce is, guess what? It meets all three criteria. Salesforce, I have been doing 14% revenue growth on my bull case, 22% net income growth. Net income should definitely grow at a much more rapid pace than revenues for this company over the coming years. Now, how are they going to grow revenues? Well, their core business is always growing revenues, right? They're always able to go up on price on their customers over time for different services. They're always selling their customers new products and services they might need, right? Additionally, they just made a very important acquisition. That's going to help boost up growth rates. Additionally, Agentforce, which they've been selling hard for the past year, that's going to really start to monetize as you push further and further in the years, like 27, 28, 29. 26 growth rates will be helped out a lot by their acquisition they made recently. Okay. Now, what do I get here for a CAGR for this stock? This is pricing at only a 29 to 34 PE. Keep in mind, that's a low PE ratio. If a SaaS company like Salesforce is growing revenues 14%, 22%, like they're going to be probably in the 40s or 50s for PE ratio. I went low range here, and I get a midpoint of around a CAGR of 25 or 26%. Base case, this is my fancy way of me saying this is what I expect for Salesforce, okay? 12% revenue growth on average per year, 20% net income growth on average per year for the next 4 years, 27 to 32 PE ratio, and I'm getting a CAGR between 18% and 24%. So we can call it 20, 21%, somewhere around there, 21%, okay? I got to buy it. Like this is, I can't not like stay on the sideline for a stock opportunity like that. Bear case for the stock. This would be if they only grew revenue 6% on average per year and 10% net income growth. This would be horrible. Benioff would be ashamed. The whole team would be ashamed over there if they only put up these numbers. 22 to 27 PE ratio, and I still get a positive return, a 3 to 9% per year, right? Gotta buy it, man. There's just no other way around it. Now, whenever you're thinking about a company and you're buying in their stock, trust matters significantly. Not just trust in the business model, but trust in the big dog who's running the show. And Mark Benioff is factually one of the best bets of any CEO over the last 20, 30 years. Like you look what he's done. He's built Salesforce from a nothing company into one of the most important companies in the world that's running the back end of countless of the biggest companies in the world now at this point in time, right? Man's an amazing salesman. He's got a team of amazing salesmen, and what he's done is nothing short of historic, and you don't bet against Benioff. And so he's still running the show there, and it's going to be, a pretty exciting next 5 years. The last 5 years, it wasn't too exciting for shareholders of Salesforce, but the next 5 years, it's going to be pretty good in my personal opinion, okay? Alrighty, next stock up here, number 2 of these 7 is Amazon. We call it around these parts, what we call it? Amazing Zon. Okay, so Amazon, another misunderstood company. The stock's up about 46% over the past 5 years. Amazon's a misunderstood company. So I said, explain it to me like I'm 5, okay? Because everybody thinks about Amazon, they order stuff on Amazon, but it's more than that. Amazon's business model is like a giant connected playground with different ways for everyone to play and for Amazon to earn money. The goal is to make everything easy and fast for the customer. That is key. Amazon's goal is to make everything easy and everything fast. And you even hear Bezos talk about that, okay? The everything store, online shopping. Amazon started as a bookstore, but now it sells almost everything you can imagine. Sometimes they buy products and they sell them directly like any other store. Other times they let other people and small businesses sell products on Amazon, right? That's a huge component of their business. The delivery network, FBA. To make shopping fast, Amazon built huge warehouses and a delivery system with its own trucks and planes. You probably see them going all over your neighborhood all the time, right? Other sellers on the website can pay Amazon to store, pack, and ship their products for them. This service is called Fulfillment by Amazon, or FBA. Then they have Amazon Prime, which is something that I signed up for very shortly after they launched Prime many years ago at this point in time, right? And so I pay like a yearly fee for Amazon Prime. The internet backbone, AWS. This is a huge moneymaker that you don't usually see. Amazon lets other companies use its powerful computers and technology infrastructure to run their own websites and apps, and even companies like Netflix and the CIA use it. ads and gadgets. Amazon also makes money by letting people pay to advertise their products on the website. Plus, they sell their own smart gadgets like Amazon Alexa, Echo and Alexa and all those things, Kindle Reader, blah, 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 right? They also have other businesses like they have Whole Foods and Twitch and a bunch of other businesses. All these parts work together like a flywheel effect. The low prices and huge selection brings in more customers, which brings in more sellers, which makes the selection even bigger and prices even lower. And all around goes and goes, helping Amazon grow bigger and faster. Beautiful, beautiful. Okay. Now, Amazon PE over time. You got to ask yourself, like, Amazon 5-year return, 46%? That's actually not that impressive. It's actually kind of bad for a company like Amazon. And you think about how much Amazon has grown over the last 5 years. I mean, their revenues are not even in the same ballpark. Their earnings per share is not even in the same ballpark. I mean, it's incredible how much this company's grown, but yet you don't have a lot of gains in the stock compared to even if you just been in the NASDAQ last 5 years, right? So Amazon PE over the years. Here was another issue. Look at the PE ratio: 93, 106, 92, 77, 58, 59, 64, 51, 78, 95. That's where the issue comes in. You pay sky-high PE ratios for stocks, you're taking a big risk. And the big risk on Amazon has been, you don't have great gains to show for. Usually, in the past, if you bought Amazon and held it over a 5-year basis, you usually were expecting to at least double your money, if not more than that. And the fact that 46% in 5 years, not that impressive. Not that impressive. No, look at this. Guess what? This is no longer an issue. 33 trailing 12-month P, forward P 32, 2-year forward P 29. The PE ratio is no longer a problem. You're no longer paying a 90 PE ratio, 106 PE ratio, or anything like that. Okay, so now we don't have a PE ratio problem at Amazon either. Now, additionally, you look at this company, this is the way you want to see your revenue growth chart over time, looking at 1000x, right? Look at that. Incredible. Latest revenue on a trailing 12-month basis, almost $700 billion. They're on the path to $1 trillion a year in revenue. Incredible. Incredible. They should be the first company to hit that. My guess is high probability within 5 years, possibility within 3 years. They hit $1 trillion plus a year in revenue. Unbelievable, right? Now, additionally, you look at the overall trend of gross margins and net margins, both are uptrending very, very nicely over the last few years here. Additionally, free cash flow, operating cash flow. Operating cash flow is much more important in my opinion because a company like Amazon is going to spend fortunes of money on CapEx because they're growing the business over time, right? So they spend fortunes of money, so that's where their free cash flow does not look that impressive. But their operating cash flow in terms of what this company actually throws off before you talk about CapEx, it's incredible. And the growth has been outstanding at this company, right? And so operating cash flow for Amazon long-term is likely headed to $200 to $300 billion a year. You heard me right. Operating cash flow for Amazon over the next 5 to 7 years is likely headed to the $200 to $300 billion range, in my personal opinion. Based upon all the trends I see, based upon where I see the business model going, think about that for a moment. Imagine a company that throws off $200 to $300 billion a year in operating cash flow. Oh my gosh. Okay. No, additionally, the shareholder equity has been skyrocketing, obviously, as they continue to invest in infrastructure. I believe, don't quote me on this, but I believe Amazon is now the second highest shareholder equity company in the world at nearly $400 billion. But if you want to know who's number one, I'll tell you who's number one. The Big Buffett. Warren Buffett's Berkshire Hathaway has a shocking $700 billion in shareholder equity. Unbelievable number. Okay. Now, what are my projections for Amazon? Where do I see the stock going over the coming years, in my personal opinion? Well, here's my bull case. My bull case for Amazon has them continue to accelerate growth rates of revenue, and a lot of that being on the back of AWS. Keep that in mind, and on the back of the ads business as that business becomes bigger and bigger as a revenue line item. So revenue, I have them doing 14% revenue growth on average per year under my bull case assumptions. 20% net income growth. Net income should definitely outpace revenue growth for Amazon over the next 4 years. They're going to have big depreciation because of the chip situation, but Amazon always has depreciation. They always are investing in infrastructure, okay? No, 35 to 40 P is pretty fair if companies growing at these sorts of growth rates. That gives me a 22 to 26% CAGR. What about my base case? Fancy way of saying what I expect. 12% revenue growth per year. 18% net income growth per year on average. 33 to 38 P would be pretty fair for a company like Amazon growing at those sorts of growth rates, and I get a CAGR rate around 20%. Banger. Look at this. This might be why Amazon, in my opinion, represents arguably the best risk reward outside of Meta in big tech land. Okay, look at even my bear case for Amazon. This would be they grow revenues only 10% per year. That's pretty hard to see that, considering the e-commerce business continues to grow nice. The fulfillment network continues to grow nice. They have AWS, which is accelerating growth rates and should continue to with the AI boom. And then you have the ads business. 10% revenue growth would be very, very disappointing for this company. That would have them not reaching $1 trillion of revenue until 2029. Okay. Now, under this assumption, 30 to 35 P would be pretty fair for 10% top line, 15% bottom line, and they get a CAGR of 13 to 17%. Ladies and gentlemen, Amazon is incredible risk reward, incredible. And the way I think it, the best way to maybe think about a stock like Amazon, you're giving back to yourself. You know you're going to spend a fortune on Amazon over the next 10, 20, 30 years. Are you not? Give back to yourself. Give back to yourself. It'd be like if you were a Walmart shopper 50 years ago and you're like, man, I'm going to spend a lot of money at Walmart over the next 50 years. It would have made sense to buy some Walmart stock along with all that money you spend at Walmart all the time, right? You would have done pretty well for yourself the last 50 years. You've been buying Walmart stock for the last 50 years. Like, think about that for a moment. So just think about how much you're going to spend, your kids are going to spend, right? Your nephews and nieces are going to spend on Amazon over the coming years. And then think about how much all these companies and businesses are going to spend with running ads through Amazon's products over the coming years and running AWS and all this stuff. It's a chance to give back to yourself. That's the other way I would think about Amazon on top of, the return potential profile here. Number 3 of these 7 stocks up here is Cheesecake Factory. Oh yeah, I call it cake. Cake. So, Cake's a $47 stock as of right now. Restaurant giant incoming for Cake. Absolute restaurant giant incoming. Okay. Now, Cake, here's the way I'll explain it to you like you're 5. Okay. They run restaurants. Now, their restaurants do big volume. Big volume. Big volume. Okay. Go there any night of the week. You're going to find they do big volumes. Go there on a Friday and Saturday, Sunday night, you're going to find them doing insane volumes. Okay. So they have their ATM machine, I call it, which is Cheesecake Factory. Very well known. Far majority of people watching this video right now, the Cheesecake Factory, okay? Very famous restaurant concept, very successful restaurant concept. And an ATM machine of a business model. Additionally, they have North Italia and Flower Child. These are 2 concepts that they've now proven out, and they're expanding across the United States of America. And they're going to be basically building mass amounts of these locations over the next 5-10 years. You'll see them pop up in every major city out there. North Italia, little higher end, and obviously Italian food, pizzas, things like that. Flower Child, they're going to be able to go very mass market with that. That's kind of in that 10, most of Flower Child products kind of in that $10 to $20 range. So accessible for basically everybody, and a lot of to-go business. They do about a half of their business to go. They should be very high margin over the coming years. I'm sure they'll be huge in food delivery. They're already very successful with DoorDash. As far as food delivery, I'm sure they'll continue to expand that out. Okay. So think about the next 5 to 10 years, just massive expansion of restaurants of these 2 concepts. Additionally, they have other concepts like Blanco, Culinary Dropout, and many others that they're testing right now. Now, when I say testing, that does not mean they're trying to see if these are successful. Yes, they're successful. Go to the Blanco locations out there. You're going to find they make a lot of money. They're very successful. Okay. Good food as well. Go to Culinary Dropout. You're going to find they're successful, very successful, and crazy busy. Those locations are. Okay. It's not about can those locations make money. It's about testing them around the United States and trying to see, should they take them national? Do these concepts have the sorts of margins that it makes sense to expand these all over the United States of America and put a ton of money behind these brands? That's a question. They've already figured that out with North Italian Flower Child, which is why they're expanding that across the United States, right? And they've already been happy to announce that. And they talked about even going up to 700 plus locations for Flower Child, which is incredible, right? Or around there. And then as far as these concepts, it's like, let's try some concepts in some different cities and let's see. Does it make sense? And then they're going to probably have another hit or 2 on their hands there, and then that will be the next 2030s growth rate wave, right? Now, Cake, you might look at this one. Why has the stock kind of been a lagger over the last 5 years, right? 24% gain over the past 5 years. Keep in mind that does not account for all the dividends. Cake has paid out over the last number of years because they are a dividend payer as well. Okay, with Cake, look at where the PE ratios were if you were buying the stock 5 years ago. It had no PE ratio. So how were you valuing this business? They had no PE ratio. They were losing money. Why? Because the world was shut down 5 years ago. And so that obviously very negatively affected Cake's business model because it was like, okay, all the restaurants had to be closed. It's kind of hard to make money when your restaurants are closed. Then when they were finally allowed to open back up, there was a whole social distancing and oh my gosh, people had to sit like way far away from each other. It was a whole situation, right? So you were buying the stock 5 years ago, you didn't even know how to value it because how could you value it, right? And then when they finally got a P on it again, it was like 300. And then it went down to 35, which is very high for Cake by any historical standards. So that's why the stock has been a lagger. You just didn't know how to value this company 5 years ago, right? And if you don't know how to value something, how are you going to say what it's worth or not worth, right? Now, listen, ladies and gentlemen, that is no longer the issue with Cake. Cake trades at a trailing 12 month of 14, PE of 14, forward P of 13, 2 year forward P of 11. We have no issue with PE ratio now at this point in time. We're looking really, really good. Look at the operating cash flow of Cake and the trend there. Look at the operating income of this company and the trend there. Additionally, what's something that's been very impressive with Cake, they're bringing down their shares outstanding, which helps your earnings per share, while they're also expanding locations. Okay. Now, one of those other significant things with Cake is you want to be able to see with somebody like Cake is, this is very important, very important. When they're going to build these new locations, not only are they doing volumes, but are customer reviews good? If customers' reviews are good, high probability people are going to keep returning again and again and again, and are happy to tell their friends and family members about this place. Oh, I went here. It was great. Oh, good value. Good, good place to go. I like to go there. I like to hang out there. I like to eat there, right? Everybody I've taken there has loved that place. That's the sort of commentary you want. You don't want 1 and 2 star reviews. People saying, oh, I tried that place. Food was nasty. Oh, I tried that place. It was way overpriced. It was crazy. Oh, I tried that place. It was so unhealthy, the food. You don't want that. You want positive commentary. So what Cake's been able to do is incredible. With Flower Child Concept in North Italia, as they expand these locations, the reviews are phenomenal. Like I looked up the reviews of Flower Child North Italia in Las Vegas, right? We have 2 of each location. We have a Flower Child in Summerlin, a Flower Child in Henderson. We have a North Italia in Henderson. We have a North Italia in Summerlin. Nice parts of town, okay? And so far, like the reviews have been phenomenal. Like this is a Henderson location here for Flower Child, 4.3 stars. Like that's all you can hope for as a national chain. Like, are you kidding me? 4.6 stars on the Summerlin location on 1.4 thousand reviews. As far as North Italia goes, this is the Summerlin location, 4.5 stars on 1.8 thousand reviews, right? North Italia in Henderson, 4.2 stars so far. It's relatively new, so I'm sure they had some hiccups when they first opened, but that's still pretty dang good. 325 reviews so far. So this is what you want to see. If you're investing into a company that's a restaurant chain and they're expanding, you want to be confident that when they go to open new locations, they're going to be doing volume and reviews are positive. So then, because keep in mind, this world still is a lot comes down to friends and family. It really does. I mean, even for myself, being on the internet, you would think like that never comes in mind. No, you know how many people I've had find my channel over time that were told about my channel from a friend, from a colleague, from a family member. Like it's incredible, right? I'm telling you, word of mouth matters significantly. My dad built his whole pool cleaning business and got us out of poverty and got us to the middle class. When I was around middle school, he did that all through word of mouth. He never paid $1 ever for advertising. It was just, he did great work. He was consistent. He charged fair prices and people told other people. And he got more and more pools over time and more service jobs, all from just word of mouth. So I'm just telling you, always the best advertising you can ever get, especially for a B2C company, is word of mouth, man. That is the king. That is absolutely king in regards to this matter. No, because people are always going to put the most trust in friends, family members, colleagues, those sorts of things if they hear something great or they hear something really bad, right? No, when it comes to Cake, here's the deal. Okay, bull case for Cake. 9% revenue growth I have, 11% net income growth. I would get, under this assumption, 28 to 33 PE, if they could keep at those sorts of growth rates, I would get a CAGR well into the 30s, okay? A little ambitious with my bull case, as it should be. My base case is basically what I expect. 7% revenue growth per year, 9% net income growth per year for Cake. Net income margins still only being 5%, 25 to 30 PE ratio on my lovely Cake here. And what do I get? A CAGR between 27% and 33%. No, you might say, if you're a little more sophisticated, you might say, okay, how does Cake go from a P ratio right now of, let's say, 14 to 25, right? So a pretty big step up there. Not a double, but a pretty big step up. Here's how. If Cake can continue to show accelerating revenue growth, which as the North Italia side gets bigger and the Flower Child side gets bigger, they should show accelerating revenue growth in 26 versus 25, 27 versus 26, etc., right? Additionally, very important, with North Italian Flower Child becoming bigger and bigger parts of the business, the entire margin profile of the company should continue to increase in future years, meaning gross margins should go up and net margins should go up. Which means you can re-rate your P ratios on the stock. So if you can have revenue growth acceleration, net income acceleration, earnings per share acceleration, you're going to be able, in margin acceleration, you're going to be able to command a much higher P ratio than the, in my opinion, crap P ratio the stock has on it right now. A 14 is a mile and a half away from where the market in general is trading at. And Cake should outgrow severely outgrow an average stock's net income and EPS over the future years. So this is where it matters significantly in regards to Cake. And that's why, if you're wondering, how do you get to a P ratio that's much higher than today and out of this kind of like crap range, that's how we do it. Now, my bear case for Cake, guess what? This is a very sad base case, or bear case, I should say. 5% revenue growth on average per year, 5% net income growth on average per year. Those are bad numbers. 14 to 19 PE ratio, so they stay in the kind of the crap range for PE ratios, right? And what do I get in the stock? A 6% to 14% CAGR. Ladies and gentlemen, listen. If I can run my bull case and get a 30% plus CAGR, a base case and be a 20% plus CAGR, and I can run a bear case and I'm still probably getting a CAGR that's going to beat the S&P 500 over the next 4 years. This is why I consistently buy Cake. I've been buying Cake for the last couple of years consistently. And this is why. Because the risk reward is there. Now keep in mind, Cake also has a dividend. So they pay me out money every 3 months to all my different portfolios. And so I take that money, and you know what I do with that money? I either buy more Cake shares or I buy shares in another stock, right? And that's regardless of what's going on in the market. The market can be going down, Cake pays me my dividend. Market could be kangarooing, not going anywhere, Cake pays me my money. Market can be going up, pay me my money. It doesn't matter. And so that's a beautiful thing with Cake. I love that company. I'm very excited for where they're headed in the future years, and I can remain a buyer of Cake, and I'm going to remain a buyer of Cake. Okay, next one up here, number 4 of these 7 stocks up here. I call this one 101. It's a 101 company. You know what it is? Nike. Ticker symbol on this one, NKE. Stock is $65 as of today. It's a 1 of 1. I call it 101. Okay, now the thing that's going to catch your eye with Nike, okay, one of the most incredible brand, like you can never build this brand again because no one is willing to invest that much into the brand to ever compete with Nike. So it's basically impossible to ever build a Nike again. Everybody and their grandmas tried, and boy, have they tried. And decade after decade, they fail. And it just remains that, right? Shoe brands can be hot for a few years, clothing brands, but they always fail in the end, and they can never become the one. Nike's got it like that. But the thing that's going to draw your attention with Nike is like, dang, that stock's been awful the past 5 years. 52% down. Oh my gosh. What's going on there, okay? I'll explain it to you. I'll lay it out because it's always important to understand, like, why did that happen, right? Here's the deal with this one, okay? So there was a slight valuation problem in Nike if you were buying this one 4 or 5 years ago. But that's a slight problem, okay? It wasn't like this had a crazy PE ratio on it 5 years ago, 4 years ago. It was just too high. But the main problem is this man, John Donahoe, okay? This man took over the company at the very beginning of 2020, literally January 2020, okay, and led the company to basically the fourth quarter of 2024, All right. And this man is the reason the stock has sucked, in my personal opinion. Okay. What he did was he wanted to go big direct to consumer, which if you're from this consulting world like he's from, you run a lot of numbers. You're a little bit of a bean counter, as they call you. Okay. And so he's running his numbers. Ooh, Nike, our brand's so strong, we don't need to sell as much product to retailers. We can go in-house with a lot of this stuff. And, people will go and they'll download the Nike app and they'll go to the Nike website, and that's how they buy products. And then we'll make way more money because we can charge the same price that a retailer would sell it for. But somebody like Nike's always going to, shave a bunch of money off that to sell it to the retailer. Let's say it's a Foot Locker, whoever it is. Okay. And so you can make way more margin if you sold the same volume, right? By selling on your own website versus selling to retailers, because retailers need to make money. So they're going to sell those pair of shoes for $150 that you would sell on your website for $150. The difference is you would make way more margin because you might sell those to that company for $90, right? And so the retailer, if they sell them, they make $60, or $50, whatever the price is, right? So his genius idea was do this. Now, the issue is, guess what? That sounds great on paper. It doesn't work out in reality because these retailers are very important, extremely important. Guess what? Malls are still important. Malls are still packed. Did you go to the mall on this Black Friday? If you did, it was a zoo. And here we are about to go into 2026 and people still love going to the mall. Even me, myself, I go to the mall several times a year, every year. And that's even though I have Amazon Prime and I still, shop mostly online. Guess what? I still end up at a mall many times a year. Sometimes I like the experience. I like to go to actual Nordstrom or whatever store, Neiman Marcus or, Foot Locker or whatever, and just, browse products and buy products. And I do that. And people still do that in mass amounts. And so those stores are very important. So when you stop selling them as much product, what they're going to do, they're going to fight for survival. Retail's a tough game. Ask anybody that's ever worked retail, it's a tough game. So what these other companies are going to do is they're going to start promoting other shoe brands, other companies, because they still need to make sales. And so now you just created more powerful competitors. This is why it's such a dumb idea. And not everybody, guess what, wants to download the Nike app. Maybe I'm going to do that. I buy Nike products all the time, straight from the Nike app. Not everybody wants to do that. Some people want to go to Foot Locker or Champ Sports or whatever other stores they like to go to buy those sorts of products. So this guy made a huge mistake and he caused competitors to get stronger. He caused Nike to get weaker because he went after margins in the short term. But that's to explain why the stock went down 50% over the last 5 years. The great news is all that is being reversed. This man, who actually comes from the Nike background, this is one of the most important men in building Nike into the powerhouse it is today, Elliott Hill. This man left Nike in 2020, okay? Retired. My guess is, he's never come out and said this. I've watched many interviews. I'm trying to see him slip up and mention it. My guess is, this is just my opinion, Elliott Hill was supposed to be the next CEO of Nike, and they overpassed him. That stupid board of directors, they overpassed him for the consulting guy. And he was like, all right, just like that. Screw you guys. I'll just retire. I made enough money from this company over time. I'm out. Have fun. And oh, did the company have fun? And what do they have to show for? The stock that's down 50%, been cut in half over the last 5 years, despite the market doing very well the last 5 years. It's embarrassing. And to happen to a one-on-one company like Nike, it's embarrassment. So the board of directors came crawling right back to Elliott Hill and said, we're sorry. We screwed up big time. Please come back. And he came back, took over the big dog role, and the rest is history. He's basically reversing all the bad decisions, getting the brand back on the right place, getting all the relationships with the retailers. He's into the nitty-gritty. He's got his team all made now at this point in time, and now they're just in execution mode, and they're ready to rock and roll in 26, 27, 28, right? And thank you, Elliott Hill, for getting this ship back right, pointing in the right direction, right? Now, we can already see his changes are starting to actually take hold now at this point in time, right? if you look at Nike's revenues, it was bad, right? And this is why Consultant Man got kicked out of the company. It was no bueno, right? Flatline revenues, then they went negative in a big major way. And now he has Nike back to growth again. It's a small amount of growth, right? But at the end of the day, when you go from negative 12% revenues to positive 1%, that's a huge inflection in business model. And it shows you're starting to position your company for growth again, which is significant, okay? And that tells you the turn has already started. It's not like if this latest quarter, like they came in with a negative 13% revenue or negative 15% or something, we would have been like, not sure the turn has actually happened, or it's happening yet. Like it might still be a while. No. You go from negative 12% revenue to plus 1% on just a quarter-over-quarter basis. The turn's happening. Your chains have actually started to take a, roll there. Now you might say, how did the company grow prior to Mr. Consultant being there? Because Nike used to be a super consistent growth company. It was one of the most beloved stocks in the stock market before it became one of the most hated stocks in the stock market and got cut in half over the last 5 years, right? What were the growth rates like? What did you expect from Nike prior to the consulting guy taking over the company, right? Well, this is what you expected. 4.5% revenue growth, 6.5% revenue growth, 12% revenue growth, 10% revenue growth, 10% revenue growth, 7% revenue growth, 4% revenue growth, 7% revenue growth, 10% revenue growth, a consistent, nice, growing company. And that's where I believe Elliott Hill is taking the company back to. So what you're going to see from Nike over the next, let's call it 3 years here, in my personal opinion, you'll see revenue growth accelerate. Is Nike ever going to be a company growing revenue at 30 and 50% clips? No, not that type of company. Okay, they don't need to be that type of company. They just need to be a solid, growing company over the coming years. Okay, if they can grow revenues each year, let's call it 5 to 15%, huge win, huge win. They don't ever need to have 20 and 30 and 40 and 50% revenue growth for this stock to be a massive success. Okay, additionally, have margins trend up. Additionally, have earnings per share trend up. And have the Wall Street community be able to trust Nike's numbers and get back to a company that consistently comes in and beats your earnings per share, comes in and beats your revenues, right? And every Wall Streeter out there is going to come right back to the stock. Every hedge fund manager, they're going to love it, right? Now, here's a deal with Nike. I'm getting this stock today in 2025 at 2015 pricing. And the turnaround has already started to occur. I'm not going to be able to sit on my hands and not buy Nike. Come on. Are you flipping my flapjacks here? I got to buy that. It's just easy. It's easy peasy. That's lemon squeezy. Alrighty, ladies and gentlemen, stock number 5 of these 7 stocks up here is, we call it Elf on a Shelf. It's Elf Beauty. It's a $76 stock here today. Over the past 5 years, this one has certainly done very, very well for itself and is up 248%. Elf on a Shelf is a cosmetics company, beauty company, and has been a very fast-growing company over time. So if you're wondering, how did the stock do so well? It's because they've grown revenue in a massive, massive way over the last few years. This is where we're at right now. This is where we're expected to get back to. As far as growth, don't be surprised if growth rates are even better than what analysts expect, right? Now, as far as weakness recently in the stock, a lot of it comes down to it's just a very negative time with sentiment around Elf stock for really 2 core reasons, okay? One is really around tariffs, okay? Tariffs is a huge deal, and it's kind of hurt their margins short term, and at the end of the day, they're going to offset that with pricing, and you're going to see their margins likely inflect back positive in 26, so do keep that in mind. Another thing they did was they did the big Rhode acquisition of Rhode Beauty, which is Hailey Bieber's company, recently, and so that's been kind of a big money suck for the company overall as well, so do keep that in mind. So, and kind of hurt their margins short term, the net margins, you got a bunch of acquisition costs in there. It is what it is. It is what it is. It's all short term stuff that's not going to matter. Like this tariff stuff, they're going to be able to offset that over the next year, no problem. And I wouldn't be surprised if their margins end up a lot higher a year from now than where they're at right now, and a lot higher than we've ever seen them before in Elf's history. So do keep that in mind, okay? Now, when it comes to Elf, everything I look at with this company, and I've been an investor for many, many years, I'm 100% convinced they're going to become a cosmetics giant, a beauty giant, okay? Not a small company, a giant. And when we start talking about cosmetics giants, beauty giants, we're talking about tens of billions of dollars of market capitalization, okay? The big dog is L'Oreal at a $234 billion market cap. Right now, Elf is a $4.5 billion market cap. It's just a little guy. It's just a little guy out there. And 100% convinced they're going to become a cosmetics giant over this next 5 to 10 years. And you'll look at e.l.f. and you'll be like, if you want a cosmetics giant, you buy e.l.f. Right now, people kind of look at it and like, you want a growth company, you buy e.l.f. In the future, it's going to be like, you want a consistent, like absolutely behemoth in the cosmetic space, you buy e.l.f., right? And as they grow bigger, their power becomes more immense. No, they've also bought some brands over the last few years that are really, I would call them like cult-like brands. Like you look at this one, Naturium brings its cult favorite skincare and body care to Amazon Canada, right? They acquired Road Beauty here recently. That acquisition is now done, and that's got a very strong, I would call it like cult-like following, especially with a lot of the Gen Z in regards to this brand. So this one has immense growth over the coming years, and e.l.f.'s going to help that brand grow massively. And as far as Rode, like they're still very early days. They sell on Rode.com, and then they sell on Amazon, and they just started selling at Sephora here very recently. So there's a lot of expansion in regards to Rode ahead for this company. Now, keep in mind, I've been an investor for years. These shares I bought February 27, 2019 for e.l.f. Got in at $7 and some change when we made 953% on that, made $69,000 on a little $7,000 investment. So I've been an investor for years, but with that being said, I'm actively buying the stock this year. And I plan to continue to buy more shares of this stock. And if you look here, this position has been built very, very recently in one of my portfolios, $63 average price here. And, pretty significant position, already 2,000 shares of that stock, $153,000 position. So, and I want to buy more e.l.f. shares. So this is one that remains a winner chicken dinner. And I think I'm just convinced they're going to become a cosmetics giant. There's no one out there in the world that I can really see competing with e.l.f. Because you have companies that compete, you have like influencer brands that those just stay small, right? Okay, so that's a segment. You influencer brands, small little brands like that, okay? And then you have some big companies that really compete in a great way in the high end. Estee Lauder, EL stock, a stock I own, right, is a perfect example of that. And then you have, super high end brands like Louis Vuitton sell some makeup related products. Chanel sells some makeup related products. Hermes sells some makeup related products. Those are at the super high end, like, the 1% buys those sorts of things, right? And then you have cheap brands that are kind of in that $10 to $20 price point, right? But a lot of those brands are very old and do not understand the marketing game on a high level and the product game on a high level to really attract the younger folks, a lot of the millennials, the Gen Z, and things like that. e.l.f. gets it. And so my opinion is they'll continue to buy brands where they see, and keep in mind, a lot of the big cosmetics brands also are owned by huge conglomerate companies that aren't even really, it's not going to move the needle for them to go buy a Road Beauty. Road Beauty wouldn't be interested in buying, getting in with some of these brands because they would say they're going to crash and burn. Somebody like Hailey Bieber is going to sell her company to e.l.f. and likely get upside on the back end as far as that, brand does well over the coming years as well, because she understands like e.l.f.'s going to be able to successfully continue to help them scale out and grow because they get it. Like they get it. They understand 2025 marketing, where things are going over the coming years and product distribution, all these sorts of things. Big company, like, is Procter & Gamble going to look at somebody like a Road Beauty and try to acquire them? Probably not. It's not. It means nothing to them. Like those companies were in big acquisition mode like 20, 30, 40, 50 years ago. But now if they're going to look at an acquisition, they usually want it to be a multi-billion-dollar type acquisition because those companies are just so big that, for them to buy a $100 million company, a company doing $100 million of revenue, it's just like not even worth their time, right? So e.l.f. will be able to outflank everybody over the coming years as well. And then someday e.l.f. will become a cosmetics giant, like I believe they will, and then they'll get outflanked by some newcomer. But for now, the party's on, okay? Number 6. Wait. Let me say this. 6 before 7, okay? 6 before we get into 7. We got 2 stocks here. I'm going to be sharing with you number 6 before we get into number 7, and they're both $2 chucks, okay? So I thought since they're both $2 chucks, we just share the spot, and then I'll do a separate stock for number 7. And those 2 stocks are FuboTV. It's a $2.90 stock here today. It's up 77% in the past year. They now have the Hulu plus Live TV acquisition done at this point in time. They're putting themselves on a great path for profitability, like sustainable profitability and revenue growth. They're in with Disney now at this point in time. And I like it a lot. Like, it's very well positioned. The balance sheet's pretty dang strong. It's not even very spec now. Like, back in the day when their balance sheet was weaker, when they were taking huge losses, very speculative stock. Like, I could understand why it's $2. It's not even that speculative now. They have a huge customer base now that the Hulu deal's done, the Hulu Plus Live TV deal's done, right? They have a very strengthened balance sheet now with hundreds of millions of dollars on that balance sheet, right? They're putting themselves in a position now for sustainable profitability, and they got the connection with Disney, who owns so many of the most important sports networks, and that's always been the biggest key for Fubo. So, gosh, like, and also I think Disney wants this new entity, because Disney owns, if I recall, 70% roughly of this new entity, which is Fubo, basically owning Hulu Plus Live TV. My opinion is Disney wants them to win, because if YouTube TV gets too powerful with Google there, that could be an issue. You need a tissue. The other $2 chuck I really like is the Honest Company. It's $2.72 stock here today. Stock's been decimated over the past year. It's severely mispriced in the market, in my personal opinion. When I look at Honest, I see a CEO that took over that company. The company was on its way to bankruptcy. And now you look at that company, $70 million roughly of cash on the balance sheet, debt that's non-existent, and now profitable. Like, and now she's even taking things to the next level and making sure they get out of some product categories that you don't want to be in, that are hurting their margins and hurting their expansion opportunities. It's incredible. The stock is so severely mispriced, it's not even funny. But it's probably a tax loss harvesting candidate, because, if you've had a lot of gains, somebody looks at an Honest, they're like, oh, I got losses, write that off against gains before year end, and it is what it is. So I don't even think people are thinking long-term on Honest right now, as they're not thinking long-term on Fubo either, in my personal opinion. That's why the stocks are $2 chucks right now. And I think we'll look back not even that long from now and be like, that was silly. Remember when Honest and Fubo were $2 chucks? Yeah, I remember. Alrighty, number 7 of these 7 stocks is, I call it Adobe stock. $322 stock here. Adobe stock, listen, I spoke extensively about Adobe stock on the 2 videos I did recently on the channel. Now, I spoke about other subjects on those videos as well, but I spent a lot of time on Adobe in these 2 videos. This one, I spent $22,000 on this growth stock today. And then this video here, the number 1 stock I'll buy the remainder of 2025. Watch those videos if you want to hear me talk more about Adobe some more, okay? Stay focused on long term, folks. There's a lot of stuff always going on in the short term, and that's going to be what that's going to be, and it's here today, gone tomorrow. Long term, great companies, prosper, do very well for you, and so always stay focused on the long term. Once again, ladies and gentlemen, pin comment down there. We are closing the private group to new members on December 14th. It's less than 2 weeks from now, so if you want to try to join us in there before we close it down to new members, and the reason we're doing that is just demand's been overwhelming. I need to close the group for a bit to new members. It's been ridiculous this year. So that'll be pinned comment down there. Access to the entire library of premium courses, access to my private Discord chat, access to 1,000x stocks, exclusive weekly videos. I did a video for the private group today, exclusive video for them. See the stocks I'm buying, selling each week, all that good stuff. Much love and have a great day.